market's moving more on headlines than it is actually on data.
You can't underweight tech. You still have to be where growth resides.
The tech AI spending is the juggernaut that's empowering this market higher.
The next 12 months, we see a broad rotation out into everything else.
There's some concern right here where we are, but people want to be invested in this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Big tech looking to build on record highs as tariffs and plenty of exemptions come into focus. More Fed officials, meanwhile, voicing concern about the labor market ahead of the latest read on jobless claims, with Trump planning to nominate a temporary member to fill the open Fed governor's seat, and the U.S. saying that a meeting with Russia and Ukraine may take place within the next few days. We have to start with a new round of tariffs as we look to the reciprocal tariffs going into effect. A whole host of new tariffs being announced. Is this the beginning of a new world order, Annmarie, or is this the beginning of a new round of negotiations?
Well, it depends on the country. For some countries, it's the beginning of a new world order. And I'm thinking of the United Kingdom, the European Union, Japan. They actually struck deals with the United States. For other countries, like Switzerland, which right now is holding an emergency meeting with the president, who was in the United States, was in Washington, D.C., only met with Secretary Rubio. That cabinet is meeting on emergency response to 39% rate, the highest in terms of developed countries that trade with the United States. And India, they have a 25% tariff. They're also facing an extra 25% because Donald Trump is trying to make it a point, the fact that a punitive point, that they are still importing Russian oil and gas. But there's an asterisk to that one. That doesn't happen for the next 21 days. So potentially it's giving time for trade talks.
It's good that you mentioned, and it's the right call to mention the different countries and what exactly the different motivations are. It seems like some of these particular tariff rates are incentives to get some sort of leverage over investment in the U.S. or geopolitical rearrangement, not necessarily a reordering of trade. And I'm thinking not only of what's going on with India, but also the 100% tariffs on semiconductors. Sounds big. You saw yesterday some of the semis, not just the semis, but also the tech companies reach new record highs. Apple surging more than 5%, its biggest one-day return going back to May, because they are exempt. How much is this really the path of travel?
Exactly. There's shock and awe coming from the Oval Office, and then you look at the fine print, and you hear from some of these companies. TSMC today is coming out and they are saying, or the minister in charge of the National Development Council is coming out and saying TSMC is exempted from the chip tariffs because it has set up plants in the United States. So that's pretty much almost everyone. There's also questions whether these are actual just semiconductors or products that have semiconductors in them. But most of those products, like Apple yesterday, Tim Cook with the president yesterday, adding more billions of dollars into the United States in investment, they are basically saying, okay, this is our carve out, this is our exemption.
Meanwhile, there's a question about the economic ramifications, with some people still saying you are going to see the economic pain filter through, pointing to the labor market report on Friday. We do get a new round of jobless claims today at 8:30 a.m., about 2.5 hours Eastern time. We do hear more Fed officials nodding to the potential, Annmarie, of cutting rates in the near future.
Yeah, that chorus is getting a lot bigger and a lot louder right now. So you have Lisa Cook calling the July jobs report, quote, concerning. And then you have also Neil Kashkari saying it might be appropriate in the, quote, near term. Well, what is the near term? We're in August, September. So you have more Fed officials lining up potentially what the market is expecting, which is this rate cut we might see from the Federal Reserve come September.
Yeah, yesterday we saw a new record high on big tech. Not really a concern there. Building on that this morning, what we can see across the board, trying to get a second day of gains. S&P futures up 0.75%. NASDAQ futures up 0.8%. Russell 2000 leading the pack with expectations for rate cuts, and a real question around whether the weakness is a head fake, backward looking, and some of the strength is going to be forward looking that we've seen on the heels of earnings. Coming up this hour, we've got Ben Laidler of Bradesco with investors digesting the latest tariff developments. James Fishback of Azoria, with President Trump planning to name a temporary Fed governor, and maybe his name is in the list. And Kelsey, Berro of JPMorgan Asset Management, as Fed officials warn of a U.S. economic turning point. We begin this hour with our top story, President Trump's sweeping tariffs taking effect today. Bloomberg's Tyler Kendall joins us now. Tyler, how much are tariffs going up, and how much are these still in negotiation?
Yeah, hey Lisa, good morning. Well, after months of threats, we're seeing these new tariff rates go into effect as of 12:01 Eastern this morning. And what is clear is that our trading partners are facing higher rates, some starting at 10% and really building up from there. Our analysts at Bloomberg Economics say that the average U.S. tariff rate will rise to 15.2%, substantially higher than the 2.3% when President Trump took office. But importantly, as you alluded to, we're still waiting on some key details of these deals, even as those tariff rates go into effect. I'm thinking about some of our key trading partners that were able to secure perhaps a more preferential rate of 15%, like Japan, South Korea, the European Union. They're seeing that lower rate extended to some key sectors like autos, but we haven't seen that codified in text. So we're still waiting on the details on that, as well as some of the details on what the administration would dub these unique agreements, these unique frameworks, such as some of the crucial aspects of these investment pledges, as well as key pledges to purchase more U.S. LNG and agricultural products. We need to see what those actual details are going to look like. Of course, we would be remiss if we didn't mention those countries that weren't able to secure some sort of agreement ahead of today. Of course, Switzerland left yesterday, the Swiss president, without a meeting with President Trump or a lower tariff rate. It's our understanding the Swiss government is now holding an emergency cabinet meeting to deal with the potential fallout from a 39% tariff. Of course, Lisa, we're going to be watching the economic impacts ahead, but we have to keep in mind there are more tariffs coming as we wait for those announcements on pharmaceuticals and semiconductors.
Tyler Kendall, thank you so much for that. We'll be catching up with you in the next hour. Here's the view on Wall Street. Ben Laidler of Bradesco BBI writing, markets face a possible reality check over the seasonally weaker summer months, with tariff and economic slowdown complacency high, in support of Trump and Fed puts both in doubt. Ben joins us now. Ben, thank you so much for being with us. I want to start there with signs of complacency. Is it complacency about the economic damage on the heels of tariffs? Is it complacency about the labor market? Where are you seeing the sign of complacency?
All of the above. It's slightly remarkable to me that we have a market which is at way above average valuations, with way above average earnings expectations, with way below average volatility at a time when the economy is clearly slowing and the tariff bill, which we know is coming, hasn't even started to be paid yet. And just for good measure, we're going into the weakest 2 months of the year. So I think that is a setup which makes me feel a little bit nervous over the next couple of months.
So is this a matter of chop, which is something we've heard a lot from people, or is this a matter of some sort of economic turn that people haven't really accounted for, especially on the heels of earnings that came up pretty positively?
I think it's more about the lack of upside rather than the sort of absolute, downside. I just really struggle to see when you have a market on 22 times earnings with 13% earnings growth, profit margins at all-time highs, increasingly supported by, forget about the Mag 7, the Mag 4, there are only two ways to make money in markets. It's either valuations or earnings, and they both look sort of stretched. So it's the lack of upside I worry about rather than the sort of absolute downside. And I just think there are better risk rewards in other parts of the world, quite frankly.
Like what parts of the world, Ben?
Or like any part of the world, quite frankly. I mean, EM,
anything but
Europe.
America? Is that your trade?
Well, I don't want to overdo that, but the US does stand out with very extended profit margins, very high earnings expectations, a strong currency, and a well-valued equity market. So you have a sort of triple premium there, and you have the reverse in the rest of the world. You've got some combination of cheaper markets, more depressed earnings, and cheaper currencies. And just simplistically, I just think that improves the risk reward, and it gives you more ways to make money.
It sounds like you don't think the U.S. is exceptional anymore. Is that accurate?
I don't think so, no. Well, maybe it's becoming exceptional in some of the wrong ways in terms of the institutional instability we're seeing, the policy uncertainty. I mean, none of that is good, and I think ultimately it will impose a cost. I'm not saying the rest of the world's fantastic. I'm just saying that it is priced for much more realistic earnings expectations, and the bar is just much, much lower for investors and for expectations to beat. So, I spoke a lot about emerging markets. Brazil, it's the cheapest market in the world, highest real interest rates in the world. The economy's doing fine. It's a closed economy. It doesn't really matter what goes on in the rest of the world. That looks like a better risk reward than the US on 22 times earnings with all-time high profit margins and double long-term average earnings growth expectations.
Ben, when was the last time you were more underweight the United States than you are right now?
Yes, so I would absolutely be overweight the rest of the world versus the US. Again, I think you make money everywhere. It's just,
No, I'm saying
when was the market has already spoken.
Right, but when was the last time that you were this underweight the United States? I'm just wondering if there's a historic reference that we could look to understand just how bearish you are in the prospect of upside, not necessarily downside, but upside for the United States.
Yeah, I mean, historically, I've been a secular bull on the US for at least the last 5 or 6 years. And again, I'm not a bear now. I just see that, again, bringing it back to basics, you have very high earnings expectations and very high valuations. You basically, for the US to outperform from here and for you to make significant money in the US, you essentially need to argue that we're going off, into the unknown, either on earnings or on valuations. And if the economy was booming and everything was great, maybe I would make that case. But I think given this given the setup right now of a fading economic growth and the policy uncertainty, it's difficult to make that case. And again, I think the rest of the world just has this sort of triple discount, which makes the risk reward just look a lot more attractive.
Before we let you go, how much would a rate cut really change your view, given the fact that we're hearing a number of different Fed officials line up and really indicate they're ready to go?
Well, certainly the market's pricing that. But I do think there's, that Fed put is maybe not as secure as people think. The market is now pricing a 90% chance of a September cut, 5 cuts over the next year, and core inflation's still running at nearly 3%, and we haven't seen the impact of the tariffs yet. I'm not sure I would make that bet. I think there's a little bit less policy flexibility there than the market would like to think.
Ben Laidler of Bradesco BBI, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. President Donald Trump's new country-specific tariffs have taken effect. As Tyler said earlier, according to Bloomberg Economics, Trump's actions will push the average U.S. tariff rate to 15.2%, as some countries face duties as high as 50%. The president says the higher levies will slash trade deficits and push companies to move manufacturing to the U.S. Meanwhile, President Trump indicating he'll likely nominate a temporary instead of a permanent Fed governor to Adriana Kugler's soon-to-be vacant seat. Trump also reiterating he considers the two Kevins, Warsh and Hassett, as top picks to replace Fed Chair Jerome Powell. Fed Governor Kugler will vacate her role tomorrow, and Trump says he will announce his pick this week. And Trump is set to meet with Russian President Vladimir Putin within the next few days, with the Kremlin confirming the two sides have agreed on a venue. The agreement comes as the U.S. pushes for an end to Russia's war with Ukraine, and it comes as Trump has threatened to hit purchasers of Russian oil with secondary tariffs unless a truce is agreed to by Friday, tomorrow. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And I got to say, Annmarie, we've been hearing a lot about this Russia-U.S. meeting, a possible Putin and Trump summit. Yet the United States is saying it's going to be a trilateral. Russia is pointing to a bilateral. The U.S. saying they want Ukraine involved. So which is it?
Well, this is what Steve Witkoff presented to Vladimir Putin in his 3-hour meeting yesterday in Moscow. He wants it to be trilateral. Zelensky, Putin, and Trump at a table. We heard from Yuri Ushakov overnight from the Kremlin. He's chief foreign policy advisor to President Putin. And they said they just want to, for now, focus on Putin and Trump. So for now, it looks like it is just going to be those two. But potentially, there is some wiggle room to add Zelensky either on another day or a future summit.
All right. Well, we're going to be discussing that and more up next, making a mark on the Fed.
We've started the interviewing process. We have some great candidates. It's probably down to 3. We're probably going to go with a temp and then a permanent. The temp is going to be named, I'd say, over the next 2-3 days.
Azoria CEO James Fishback joins us next to talk about whether he could be a possibility. You're watching Bloomberg Surveillance. Seeing a lift to start the day. Futures higher by a significant amount, up almost 1% when it comes to the NASDAQ. S&P futures up 0.9%. Expectations for a rate cut really affecting the front end, where you're seeing yields lower. On the long end, not so much, 4.24% on that 10-year yield after a little bit of a messier auction yesterday. And dollar weakness ongoing, 116.65 on the euro-dollar cross. Under surveillance this morning, making a mark on the Federal Reserve.
We've started the interviewing process. Scott and I and Howard, a lot of people, JD, we have some great candidates. It's probably down to 3.
Are you candidates from Wall Street, Mr. President?
Yeah, essentially we're all from Wall Street, aren't we? You know, when you get right down to it. We're probably going to go with a temp and then a permanent. The temp is going to be named, I'd say, over the next 2-3 days.
Here's the latest. President Donald Trump saying he'll likely nominate a temporary Fed governor to fill a soon-to-be vacant seat. Trump adding the decision will be made in the coming days. Joining us now is someone whose name has been floated for the position, Azoria CEO James Fishback. James, thank you so much for being with us. Let's just start with what you know about the process and how intimately involved you are.
Well, good morning, Lisa. I think it shocked everybody last week for 2 reasons. The first of which, for the first time in 32 years, we had 2 Fed governors dissent against the chair. And then second, we had a third Fed governor abruptly resign on Friday, Adriana Klugler, without explanation. So it's given President Trump yet another opportunity to shape the leadership of the Federal Reserve, and he's going to do just that.
Well, he's looking potentially, and he said there, and I had a reporting on this yesterday, James, good morning, that this could be a temporary position, meaning this person would just serve out the remainder of Governor Kugler's term. So they would leave their job, serve in Washington for about 4 months, and then that would be it. Is that something you would consider?
It is something I would consider, Annmarie. I told the president that on Monday when we spoke over the phone. I think the next 4 to 5 months is especially important for monetary policy. We have a very big dislocation on our hands. Since President Trump took office, headline CPI has been running at 1.8% annualized, and we have 4.5% rates, Annmarie. The last time rates were this high, we had 6.5% inflation. It doesn't make any sense. Everywhere I travel in my home state of Florida, folks are stopping me, and their number 1 or number 2 concern is why on earth Jerome Powell is obstinate. Why doesn't he look at the data that Waller and Bowman and everyone else is looking at and lower interest rates to more natural levels?
Well, he might. We now have Governor Lisa Cook saying that the July jobs report is, quote, concerning. You have Neil Kashkari saying it might be appropriate in the, quote, near term. By the time September rolls around, the Fed might already be moving to the president's favor. Did you and the president, by any chance, discuss who he is thinking about the prime position of chair for the Federal Reserve?
Well, look, I'm going to keep my discussions with the president between him and I. But what I will tell you, Annmarie, is that this idea of cutting by 25 basis points a month and a half from now is a little too late for a man that does, of course, go by too late, that moniker that the president has rightly coined. The truth of the matter is that at the September meeting, if I were there, I would vote for a 100 basis point rate cut because, as Waller pointed out in his dissent after the July FOMC last week, rates are at least 150 basis points above natural. Look at the fact that mortgage originations are down 363,000 versus their 5-year running average. What does that mean, Annmarie? It means that families all over this country want to start a family, have done everything right, have saved up, have worked hard, but can't get a mortgage. If you can't get a mortgage, you can't get a house. If you can't get a house, you can't start a family. That is unacceptable, and President Trump is right to call out Jerome Powell on this.
That said, Jerome Powell doesn't really have control over mortgage rates. And in fact, if they were to cut rates by that much, you probably would see some sort of increase in yields in the long end, akin to what we saw last year. That certainly is
to be fair, Lisa, we saw that. Well, to be fair, Lisa, we saw that because market expectations were pricing 7 cuts in the fall. They only delivered 3 cuts, and so the repricing at the 10-year part of the nominal curve ended up readjusting to what the SOFR curve had run ahead with. There's no time really in history where the Fed had cut and mortgage rates hadn't gone down by a substantial amount. This is the same Jerome Powell that in 2020 was talking up his ability to bring down mortgage conditions, to bring down long end rates, and he actually did do that quite successfully in 2020 and 2021. So I don't accept the premise from Jerome Powell, who's all of a sudden can't do anything. He can do these things. They're well within his remit. It's time for him to act.
But we do hear from a lot of companies as they put earnings out that they are raising prices. They're grappling with just how much demand there is out there, and that the more the economy keeps chugging along, and that was the portrayal that we saw from everyone from United CEO to McDonald's, they're going to be able to pass that along. So at a certain point, how much is this a very different situation than 2020, where there's a new inflationary push that's not going to allow rates to go back to where they were, or the perceived rate of neutral back in 2020?
Well, that's a great point, Lisa. I got to give you credit for that. The truth is we are seeing limited price increases from here and there as companies are making this transition. President Trump has never made a secret this is going to be a transition period. But the way the Fed, and we should all look at inflation, is as an aggregate number. There's always going to be increases and decreases beyond the mean. But if you look at the aggregate inflation numbers, they have come in better than expected, lower than expected for the past 5 consecutive months. As I mentioned, since President Trump took office, inflation on a headline CPI basis is annualized at 1.8%, Lisa. That's not at the Fed's target. That's below the Fed's target. President Trump does not deserve a Federal Reserve that is acting out of accordance in complete rejection of the data. Waller is looking at the data. He is saying neutral. Even the Fed's own models from the New York Fed of the short-run neutral rate have it closer to 3%. And why are rates at 4.5%? It just doesn't make any sense.
James, as you know, the Fed's purview comes under Congress, and this position would have to be Senate confirmed. Some of my reporting with Saleha Mohsen is that the administration is actually looking for someone to fill this temporary position that already has been in front of the Senate and can get confirmation. Many would view you as a bit more of a controversial pick, took a less traditional path to this. Do you think you could be Senate confirmed?
Look, at the end of the day, Annmarie, the president is going to make the ultimate decision. He has no shortage of great options. What I will tell you is this is a president, unlike Jerome Powell, who surrounds himself with workers, with businesses, with retirees, with unemployed folks all over this country. He talks to them directly. Jerome Powell meets with his PhD economists. They publish papers about systemic racism being the cause of the home ownership crisis, not high interest rates or the fact that private equity companies like Blackstone are coming into communities like mine and buying up homes from under folks. So I trust that the president is going to make the right decision. And part of that, you're right, Annmarie, is the ability of someone to be confirmed by the United States Senate.
James Fishback, Azoria CEO, thank you so much for being with us. And we look forward to catching up as you continue the process. Joining us now is Bloomberg's Michael McKee as we get a host of different Fed speakers coming out and saying that it might be appropriate right now to cut rates.
Exactly, Lisa. The timing is very interesting, but it is also tied to the data that we have gotten. A lot of the members of the Open Market Committee had said they wanted to see what happened with the payrolls report and with the CPI report we're going to get next week to ensure they had a better handle on what was going to happen. Now, obviously, Mr. Fishback is campaigning for a job. So that's OK. But there's two things wrong with what he was saying. One is that Jerome Powell can do anything on his own. This is a committee of 12 voters, 19 people total, and he can't just snap his fingers and cut rates. And the majority have not wanted to cut rates. The other thing is that there is no inflation lately. Well, the tariffs haven't started until today, really. So we'll have to wait and see what happens. But yesterday you had Susan Collins, you had Lisa Cook, and you had Mary Daly all say that they think it's about time to start cutting rates if the data continue to show what they have shown the last couple of months.
Michael McKee, thank you so much. We'll be catching up with you throughout the morning, especially as we get that key jobless claims data in about 2 hours' time. And just building on what Mike was saying, we also heard from Neil Kashkari yesterday saying in the near term, it may become appropriate to start adjusting the federal funds rate. So well on their path. Not necessarily to a 100 basis point rate cut, but still 25 basis points.
Well, on their path now, when we have the labor market data, what happens if we have very hot CPI prints? We have 2 CPI prints before the next Fed meeting. What happens if they come in hot? Look at the ISM services. Everyone is saying that is the conundrum the Fed is in, this stagflationary potential environment. And what do you do then when 2 sides of your mandate are not working together for you to have this ability to cut rates?
Luckily, they have about a month and a half, so they can really discuss this. And Jackson Hole will be a very interesting meeting with some interesting commentary. Coming up next, Jim Bianco of Bianco Research taking the other side of those rate cuts, and as well as discussing Trump's potential pick for the Fed governor. Perhaps it's the beginning of a new era. We do see tariffs come into effect, with the U.S. tariff rate now effectively more than 15% from 2% at the beginning of the year. Highest levels going back to the 1930s. A real question of how markets are dealing with that. Well, they are looking to make some new highs in the big tech space after another record close yesterday for the Magnificent Seven. We're seeing NASDAQ futures push higher 0.8%. Russell 2000 up almost 1%, with the expectation that there will be some sort of rate cutting cycle and strength in the underlying U.S. economy. 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, I have one of those Mag 7 stocks that's having another really good day. It is Apple, which rallied 5% yesterday in the pre-market, up another 3%. Had that meeting in the Oval Office. Tim Cook did, the CEO, with President Trump, announcing an $100 billion investment. The enthusiasm here is that you will not get that 100% chip tariff that Trump announced if you invest in the U.S. So some of Apple's chip partners, also rallying in the pre-market. Now, on the other side of things, Airbnb reporting earnings yesterday. And look, it was okay. They meet expectations. They said that the summer bookings were looking robust. The problem for them, though, was that they said they had tough comparables for the end of the year. And that meant that growth would look pretty steady instead of robust. So that weaker kind of outlook, or let's call it mild, mean that shares are down 6.7%. But maybe if you're not out booking Airbnbs and going on vacation, you're ordering at home. And that's what we saw from DoorDash. Really strong earnings, exceeding expectations. Shares are surging 9%. They said they added new customers for every single month of the last quarter. Their outlook also exceeding expectations, too. We heard similar things from Uber. So, yeah, people ordering from restaurants, despite the fact there is some lingering economic anxiety within other earnings reports, Lisa.
Thank you so much, Danny. Maybe they're just staying at work and ordering in dinner to stay at their desks rather than going on vacation. On our radar this morning, not that. President Trump's sweeping new tariff rates taking effect, impacting nearly all U.S. trading partners. The moves raising the average tariff rate to more than 15%. Some countries facing rates as high as 50%, although those seem a little bit more fungible when we're talking about India. It just goes to show each of these tariff rates kind of, Annmarie, has a different purpose.
Right, and they're bespoke, really, depending on the country. So, as you rightly pointed out at the start of the show, is this a new world order? For some countries, it is. Or is this negotiating? And for some, it is, like Switzerland and India. They still seem to be in negotiating mode with the United States, especially India. Front page of the Wall Street Journal editorial this morning in the opinion section. Trump targets Russia via India. Basically, going after what's going on in Russia, something he also wants to bring to a close, that Ukraine war, going after the oil imports going into India. Now, this puts India definitely on the back foot, because this is a 50% potentially as high in 21 days tariff rate. What is so interesting on the economic front, for months we've been talking about how the market is pricing in the uncertainty of tariffs. Well, the next 6 months, they're actually going to have to start pricing in the actual tariffs.
And that's the reason why some people are saying people are overestimating how well the U.S. economy can absorb them without any weakness or any inflation. And we're going to be having a conversation coming up, taking the other side of what we heard from James Fishback. Jim Bianco joining us to talk about why he thinks cutting rates will be a policy mistake. Meanwhile, Trump announcing plans to raise tariffs on semiconductor imports to 100%. Okay, this sounds really bad. So why did we get record highs? Well, he promised to exempt companies that demonstrate a commitment to building in the United States. We saw NVIDIA shares, Supermicro shares, as well as TSMC all surging, and Apple coming out with that announcement that they were going to invest $100 billion to building more in the United States, them seeing a more than 5% boost, as Danny was talking about earlier.
And you know who else wasn't just at the White House yesterday? It wasn't just Tim Cook. It was Jensen Huang as well, as Trump was about to announce this, quote, 100% tariff rate on semiconductors. Jensen Huang was also there. Both these CEOs have been trying to lobby the president when it comes to exemptions. And guess what? If you read the fine print, there likely will be exemptions. When it comes to tariffs, TSMC is saying we're okay because we are still building in the United States. We are putting investment into the United States. It's that carrot and stick approach the Trump administration is trying to use when it comes to tariffs. You also saw the exemptions when it comes to TSMC. Canada looks like it has a very high tariff rate, 35%. But then when you look at actually what is being traded, most of those goods are USMCA compliant. And if USMCA compliant, your tariff rate is 0.
Which is a reason why everyone's continuing to parse through all of the details. We've been talking about, is this a new world order? Is this a negotiation? When it comes to India, it's been a negotiation to try to get Russia to the table to end the war with Ukraine. On that note, Trump is set to meet with Russian President Vladimir Putin within the next few days. This, according to the Kremlin, saying the two sides have already agreed on a venue. The agreement coming ahead of that Friday deadline tomorrow that would hit Russia with secondary tariffs. The thing that I find confusing, and there are a lot of things that I find confusing, is that the United States side talked about a trilateral meeting with Vladimir Putin, Volodymyr Zelensky, and President Trump. But there here seems to be, from the Russian side, a discussion about a bilateral summit. So which is it?
Well, when you listen to the Kremlin and Yuri Yushakov, Putin's top foreign policy aide for decades, they are talking about just a bilateral meeting between President Trump and President Putin. And he said, together with our American colleagues, we are starting to work on specific issues. This is what's also interesting for me. You're meeting to work on those issues. Usually when you have a summit, it is the final part of the deal. The deal has been worked on for months, and you are having a summit because you are going to be signing it. But on the leader level, it feels like this is almost taking a backwards approach. The leaders are going to be meeting, and then more work needs to be done on the diplomatic front.
And India is watching and saying, look, if it goes well, will you guys lift some of those tariffs? In the Fed news, President Trump saying he would likely nominate a temporary Fed governor to Adriana Kugler's soon-to-be vacant seat. I believe that is as soon as tomorrow. Meanwhile, a real discussion about what this means for Fed policy. Jim Bianco of Bianco Research writing this. Trump suggested he would appoint someone to finish out the term through January 2026. Presumably, that would be Kevin Hassett. In other words, Hassett would have a 5-month trial run. Jim joins us now. Jim, one thing that you pointed to is that in this push to cut rates, you think the Fed is going to make a policy error. Why do you think so?
Because I don't think it's necessary. I think that we've lost the sight as to what is interest rates and what is the appropriate interest rate. President Trump keeps talking about that we're the hottest country ever. Everybody wants to be in their country. Look, I agree with him. But what he seems to be implying is we're the best credit rating, so we should have the lowest interest rates. That's not how you set sovereign yields. That's how you price a mortgage on Trump Tower in Manhattan. The way you set sovereign yields is the combination of growth, inflation expectations, and supply should determine kind of a natural or neutral interest rate. And right now, that looks like, on the long end of the yield curve, somewhere around 4.5% to 5%, which is where we are right now, which is why the market has been meandering sideways. Now, if the Fed wants to cut rates and add extra stimulus into the economy, because that's presumably what they're going to do, they could push those numbers up. You know, faster growth, potentially higher inflation, and that could wind up pushing up the long end of the yield curve, like we saw last year. The yield curve went up, I think, or the long end of the yield curve, 10-year yields rose when the Fed was cutting rates, largely because after the Fed started cutting rates, the economy started to rebound, and it did what it was supposed to naturally do.
Jim, we saw the labor market report on Friday really change the tone of a number of people on the Federal Reserve. The fact that the revisions came in at the greatest pace going back to the height of the pandemic caused a lot of Fed officials to start talking about rate cuts. Lisa Cook coming out and saying these revisions are somewhat typical of turning points. How do you view that, given the fact that there are other people saying they're seeing real softness in the jobs market?
Because there is softness in the jobs market, and they are, signaling or you see them at turning points. But what is the turning point that we're seeing? And the answer is the thing that very few people are talking about. Labor market statistics are measures of population growth. We've shut the border on this, and we have got net immigration at 0. President Trump tweeted this out the other day, or put it on Truth Social, that we have net negative immigration for the first time in 50 years. And that might be correct, or it's very close to 0 either way. That means we've got no population growth. That means that the U.S. economy might only need to create 10 or 20,000 jobs a month in order to meet the population growth and new entrants into the economy. But we're all operating under this assumption that normal is 150,000 jobs a month. And that's why there's this rush to cut rates and stimulate. Well, if you're going to do that and try and force the U.S. economy to create more jobs than population growth with demand, that means you're just going to have to drag more people into the workforce. And you do that by raising wages. You do that by creating inflation. I think the other side of the equation, how many jobs do we need to create, is not being discussed. And it's not being discussed because there is no population growth. And that number might be trending towards zero. The American Enterprise Institute has said by next year, that break-even number might actually be as low as zero.
Jim, the president said yesterday, following reporting we had, that he plans to go with a temporary approach to fill the Kugler seat. How do you think the market will respond to that?
I'm wondering how they're going to, what is this, Apprentice Season 1, the Federal Reserve is what we're going with this. I mean, basically.
Game of Thrones,
first
but
of
yes.
All, yeah, or Game of Thrones, either way. I think either way, the issue you're going to have is, assuming he appoints somebody this weekend for this temporary role, and assuming it's a trial that person could also be the permanent person and eventually the Federal Reserve chairman. I don't think they're going to get approved by the Senate before the September 17th meeting. I know Trump will try to get them approved. Maybe they don't even get approved by the October 30th meeting. They might only be there in time to cast a decision for one or maybe two meetings, and then they'll have to make a decision, at the end of the year. So I think initially the market will look at it, assuming it's one of the four names that we continue to throw out, and it's not an outlier name that no one has discussed. I think the market will look past it at least for a little while because that person probably is still going to be a few months away from actually casting votes.
Well, what if it is someone like a Kevin Hassett or Kevin Warsh? Do they then basically become the shadow Fed chair? And how confusing might that be for market participants?
Yeah, I think they will become this shadow Fed chair, and it will be a little bit confusing because the market will look at a Warsh or a Hassett, or if it's a Waller, and ask the question, what are they going to do after May, assuming that they May of next year, assuming that they are the Federal Reserve chairman, and that will diminish Jay Powell's role and increase their role. And if they're at odds with what Jay Powell is saying, then I think that could create some real confusion. If it's a name that none of us are talking about that gets it, then we'll be asking the question, will they even be there after January? And that's a whole different discussion.
Jim Bianco of Bianco Research, thank you so much for those insights. It's important to hear the other side. It's amazing to see how much dissent there is right now among market participants about whether there is about to be some sort of inflationary push or whether we're about to see some real weakness in the labor market.
As you mentioned, Jackson Hole just got so much more interesting because the individual everyone wants to hear from is Jay Powell. Everyone agrees he is a dove. What is he thinking about now when it comes to the labor market, given the fact that we had basically a trend, when you look at the revisions, of a weakening labor market and more people lining up with the double dissenters that he faced at the last meeting?
Yeah, I'm also curious about Chris Waller, given his renewed position as, if not a shadow Fed, certainly a real contender to be the next Fed chair. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Eli Lilly shares are plunging nearly 13% after results from its latest obesity treatment pill fell short of expectations. In a study, patients who took the experimental pill lost an average of 11% of their body weight. Investors had hoped Lilly's pill would be as effective as Novo Nordisk's injection Wegovy, where users in trials lost 14 to 15% of their body weight. Novo Nordisk's shares are higher by 9%. Meanwhile, Chinese exports surging in July, with exports up 7.2% year over year. That marks the fastest gain since April, as demand from around the world offset a continued slump in shipments to the U.S. due to tariffs. The resilience signaling demand for Chinese goods remains strong and continues to be a significant driver for the Chinese economy. And Switzerland's government is holding an emergency meeting today to consider the fallout from President Trump's 39% tariff rates. This after President Karine Keller-Sutter failed to make a trade deal and avert the highest U.S. levies on any developed country. The Federal Council will issue a public statement after the extraordinary meeting. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I'm just looking right now that Swatch has raised its pricing on watches for the United States and is looking like a 7 to 10% increase on brands like Blancpain and Gazut Original.
Nespresso, their prices are going to be going up if you drink coffee in the morning from Nespresso. It was the Swatch CEO that actually was saying publicly, this president of Switzerland needs to go to Washington, D.C. and sort this out. We should not be facing a 39% tariff rate.
Well, she went to Washington, D.C., sorting it out. Another question. Up next, unwelcome signs in the economy.
The labor market has softened, and you can see this everywhere in the U.S. economy. And I would see additional slowing in the labor market as an unwelcome sign.
Kelsey Berro of JPMorgan Asset Management joining us next. This is Bloomberg Surveillance. Well, the tariffs went into effect. Big fear in markets. We're looking at maybe some new record highs for the NASDAQ. We're seeing right now Mag 7 continuing to chart the charge higher. We're seeing across the board gains. S&P futures higher by 0.7%. A bit of dollar weakness on the expectation. There will be Fed rate cuts and yields just slightly higher on the long end, which is a question about what the ramifications will be on the heels of rate cuts. Under surveillance this morning, unwelcome signs in the economy.
The labor market has softened, and you can see this everywhere in the U.S. economy. And I would see additional slowing in the labor market as an unwelcome sign, especially since we know, and I think importantly because we know, that once the labor market stumbles, it falls. And it falls quickly, and it falls hard. I think we'll likely need to adjust the policy rate sometime in the coming months.
Here's the latest. San Francisco Fed President Mary Daly voicing concerns about the U.S. economy alongside two other policymakers suggesting a rate cut is imminent. Kelsey Berro of JPMorgan Asset Management writing this. If economic data continues to indicate weak hiring, the Fed is likely to deliver on a rate cut in September, despite Chair Powell's more neutral tone. Kelsey joins us now. We are seeing, Kelsey, a 95% chance of a rate cut getting priced into Fed funds futures. Seems like this is almost a given. Is this the right thing to do?
I do think that it is the right thing to do. So if you take a step back, you think about what the Fed has done so far. They've cut 100 basis points. They did that last year. Then they paused. Policy right now is still restrictive. It's still above neutral. We are seeing signs that the labor market is slowing. We've been seeing these signs actually for a while. But on the other hand, the Fed was balancing the risk to inflation. I think there are still risks to inflation. We are going to see more inflation in terms of core goods. But I think the reason that the market has been able to digest it and the Fed is going to be able to look through it is because we're seeing disinflation on the services side that is offsetting some of the inflationary forces on the goods side.
So I feel like it's cognitive dissonance a little bit. When I speak with equity investors, they talk about this incredible strength and resilience and the sort of profit increase that we see at companies that really belies the weakness that bond investors talk about. And I know it's cliche. Bond investors pessimistic, stock investors optimistic. But do you see some sort of cognitive dissonance there?
I mean, not really. I mean, we're looking at two different things, but you put it best. We were in the commercial break. You said the volatility so far this year is in the headlines. It's not so much in the market. And when we came into this year, what we wanted investors to focus on are the high starting yields within the fixed income market, yields that you haven't been able to get for over 10 years. And even if yields stay range bound around here, credit spreads are range bound, which is essentially what we've had this year. We've had some choppiness, but yields are a little bit lower than the start of the year. Spreads are about the same as the start of the year. Then what do you get? You get carry, you get income in your portfolio. The U.S. Ag is up 4.7% year to date. U.S. high yield up 5.3% year to date. This is exactly what you want to see in this type of environment.
By the way, when Lisa says volatility in the headlines, I think you mean policy out of Washington, volatility in every time almost the president speaks, or truth. The more sanguine markets are there, is the president more emboldened? Could we see more volatility that actually the markets have to react to?
I think that is a risk. So we've been doing a lot of analysis on how corporations are going to handle tariffs. And we've stressed them against a 10% tariff regime. Then we were like, okay, maybe we need to stress them against a 20% tariff regime. And our corporate analysts came back and they said, it's not great for earnings. Earnings are going to slow. Revenue is going to slow. But it's manageable given the very strong starting points of companies. And they're going to use a variety of different methods to offset those higher costs.
Including layoffs?
It could be some layoffs. I think if it's not layoffs, it's at minimum less hiring. And that's what you're seeing in the economic data already flow through. The risk, though, is that once maybe you get past 10 or 20%, at a certain point, it is going to become nonlinear. Everything that we've been looking at so far, that we've been looking to measure, is essentially linear. You know, a 1% increase in this results in a 50 bip decrease in Y. And so the risk is at a certain point, all of this compounds and it creates a more negative result. So far, though, that's not actually what we're hearing. Our credit analysts are saying that Q2 earnings are coming in better than feared, and the focus is really shifting away from managing tariffs to now managing the advantages that they're getting in terms of the One Big Beautiful Bill, whether it be expensing of R&D, interest deductibility, less stringent emission standards for autos. So, you know, the focus is shifting again here for companies, and they continue to just muddle along.
As you look at the economy, is it more instructive to listen to what corporate executives are talking about than the economic data? Especially, you can put aside the BLS and what exactly happened with the labor market data, but even CPI coming out on Tuesday, real questions around just how much some of their data collection has declined and the integrity of that data. So at this point, are corporate executives better reads on the economy?
I think that you have to look at all of it. And what the jobs data on Friday really reminded us all of, and people say this all the time, you can't just focus on one data point, you can't just focus on one data series. You know, if you're trying to come up with a view on the economy or a view on where things are going to go, you need a variety of data points that all kind of, a mosaic essentially, that gets you to a conclusion. And so, yeah, maybe in this environment, we need to look at a few more alternative data points to try to enforce what we're looking at. But I think also what we do need to be prepared for is more volatility in the data. So because we have less data collections, the sample sizes may be smaller, response rates may be lower. That doesn't necessarily bias the data in one direction or the other, but it does mean that we are prone to more revisions. Now, that's something we've all been dealing with for a while. I think I would describe that as not just a new thing to the last 2 months, but actually something that we've been experiencing since the pandemic, which is that there have been a lot of large revisions that have caused the market to have to reassess the trajectory. And that's why I do think it's so important that you don't just focus on one data series. You look at a variety of data points. You focus on what companies are saying. You look at what small businesses are saying. You look at what the economic data is saying. You determine what the trend is. And you don't jump to conclusions based on just one revision or one data point.
Or you take the rest of the summer off, because right now bonds have basically been in the same place for quite a while. Kelsey Berro of JPMorgan Asset Management, thank you. Have a wonderful rest of the day. What we are seeing in markets is that lift as people look past all of the noise, listen to what companies are saying, and sort of deciding it's not that bad.
Well, Kelsey put it really well from the research team. 10 to 20% tariffs. It's not great, but we can weather that storm, and it's not going to be a material impact on our earnings. And that is why the markets is just pushing through and looking at what's coming down the pipeline next. And maybe that's some incentives from what happened in Congress and the One Big Beautiful Bill.
Yeah, for now, because a lot of people expect chop, including Sarah Hunt, who's coming up next, of Alpine Saxon Woods, former NEC Deputy Director Everett, Eissenstat, Hyatt CEO Mark Hoplamazian, and Mike Pyle of BlackRock. We also do get a Bank of England decision in just about 4 minutes' time. This is Bloomberg Surveillance.
U.S. economic data is the envy of the world.
The consumer is doing just fine.
We're unlikely to see a major reacceleration of inflation.
I wouldn't be surprised if there is no rate cut in September.
The Fed probably will be behind the curve because the tariffs create so much uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we wait for a Bank of England rate decision. As we talk about the Fed's potential move in September, the Bank of England potentially taking the lead. And indeed, they do cut that key interest rate to 4% after a 5-4 vote. We'll be getting to that in 1 second. A real question here about what this means going forward for the rate cutting cycle globally. We have seen Europe taking the charge. Does this mean that they're now going to be on hold? This comes at a time when we're trying to understand what the ramifications from tariffs are, at a time when they do go into effect today, President Trump's tariffs, and a real question going forward of what future tariffs could look like at a time where they're increasingly being used, Annmarie, as a negotiating tool.
Absolutely. When it comes to countries like India and Switzerland, it feels like they are still part of this negotiation, even though they are facing higher tariffs, and everyone is facing higher tariffs as of 12:01. Just after midnight. What the Trump administration, though, is doing is negotiating with certain countries, but setting rates, higher rates for others. And this is the whole conundrum the Fed is facing. Will this bleed so much into CPI that basically their dual mandates are working against each other and puts them in a very difficult position to cut rates? I can imagine the Truth Social post this morning is going to be, even the Bank of England was able to cut rates a fifth time, brings it to the lowest since March of 2023 and pulls ahead, of course, the Federal Reserve.
Yeah, lots of questions here, and we are going to get to that Bank of England rate decision. We're seeing a response in markets with the pound gaining versus the dollar, strengthening versus the dollar, a 5-4 decision. They're talking about how inflation will remain at 2% in the third quarter of 2027 as well as 2028. So seeing that downward trajectory, breaking it all down, Bloomberg's Lizzie Burden joining us now. What do we learn from this decision?
Well, Lisa, I can hear you saying that Donald Trump is going to be disappointed because now the Bank of England's rate is lower than the Federal Reserve's 4% here, as expected. But there is drama beneath that rate cut. So they've cut it despite inflation being at a 17-month high. But the worries here are about the growth in the economy, the contractions back-to-back that we've seen earlier in the year, and the slowdown in hiring. But look at this vote split. So initially, they had a 4-4-1 split, and then they had to recast the vote and go again. So because it was so finely balanced, they ended up on that 5-4 split, 5 voting for a quarter-point cut and the other 4 voting for a hold. The expectation, the most common expectation going into this was for a 3-way split of 2-5-2. But I have to say the expectations were absolutely all over the show going into it, just reflecting how much uncertainty there is here. In terms of the forecast, as you nodded to, in terms of inflation, they've upgraded it. So they had seen 3.7% as the peak. They now see it as 4% in September as the peak. And they see inflation at 2% in the third quarter of 2027, so way down the line, and 2% in the third quarter of 2028. That is when we will be back at the inflation target in the third quarter of 2027. So, as you say, the pound is up. It's been read as a hawkish cut, this, because of these worries about inflation.
Thank you so much, Lizzie Burden, and we will be following up as we try to understand what central banks around the world are going to be doing as a result of the tariffs and the potential pressures. Bank of England facing a unique pressure given the threats to its currency. How much can you cut rates if you still have inflation as a problem, even in the face of slowing growth? Right now, you are seeing a bit of gains across the board in the United States as people parse through all of the potential tariffs that are coming down the pike, as well as the ones that actually are going into effect, and seeing that maybe this is all baked into the price, really led by the Magnificent Seven in the United States. You can see that dollar weakness continuing this morning versus the pound after what Lizzie Burden said was a hawkish cut. Coming up this hour, Sarah Hunt of Alpine, Saxon Woods talking about increased volatility going forward in the market. Former NEC Deputy Director Everett Eissenstat as President Trump's tariffs take effect, and Hyatt Chief Executive Officer Mark Hoplamazian on resilient travel demand. We continue with stocks higher as markets shrug off the president's levies. They look to potential rate cuts around the world. Sarah Hunt front of Alpine Saxon Woods, writing this: markets are experiencing more volatility as we wind down earnings season, as excellent numbers sometimes are greeted with a yawn or a knee-jerk drop, at least on the first glance. And this is what we were talking about a lot yesterday. Sarah joins us now for more. Thank you so much for being here. Let's start with that. The idea that you saw good earnings from Uber. You saw good earnings yesterday, pretty much across the board, and yet the performance in shares kind of all over the place.
Well, good morning and thank you. This is what I think is very tricky right now, is you've got an argument that valuations have to grow, earnings have to grow into valuations, and you have some anticipatory moves in the stocks. I mean, Uber was up already, right? So I think part of the problem is you've seen these big moves in the stocks. They come in with really good earnings, and everybody's like, well, the move's already happened, or that wasn't so much better than I expected that it's going to push it again further. So I think this is, to me, a little bit worrying, because you want to see those good earnings be rewarded. But I think that the market just keeps moving sort of relentlessly higher, especially on the technology side. And those earnings better be able to fill into that. And I think that is a little bit more of a turn than we saw earlier in the beginning of earnings season.
It seemed like heading into earnings season, people said that corporate earnings were going to be the risk. They crossed that hurdle and then some. You saw a real earnings revision in terms of forecasts. Now people are saying, wait for the data to turn around. So is that really kind of the catalyst for some of this chop, the idea that some of the economic data could start reflecting some of the weakness that we saw last Friday?
I think the problem is that once earnings are out of the way and they were good news, and then the market continued to go higher. I mean, we did have a little bit of a down few days, but it wasn't sustainable, and it doesn't seem to be right now being carried through. That any weakness in the data, because you now have a paucity of earnings until you get into the next quarter, is going to be the absolute focus. And this is a tough time of the year for a variety of reasons. There's seasonality going on, people are away for the summer, and any moves tend to be somewhat outsized, which is why we think you're going to see more volatility. And in fact, if you go back and look at the last 3 or 4 years, the whole August, September into the beginning of October has been rather witchy. And so I think that is a little bit what we are anticipating. And you have things like those data numbers. I mean, the labor numbers, that was not a great set of revisions. That was not great news. And this has been the reason why you can justify, no, we don't need to cut rates because the labor market is doing fantastically. Well, maybe it's not doing quite as fantastically as we thought.
Well, on top of all these months that you say are witchy for a number of seasonal issues, we also have now much higher tariff rates. Mm-hmm. When are these companies going to digest that? When are we actually going to see the impact?
Well, and that's the other big question, because the anticipation on that has been going on for so long, and the knowledge that they were coming has been going on for so long. It's hard to see under the surface who's been able to mitigate some of that ahead of time and who hasn't. As we get closer, as this gets implemented, and then the question becomes, there's so many carve-outs, does implementation mean versus not implementation? We're going to see that change over the next few months as that starts to get absorbed. Is that going to hit margins? Is that going to be a bigger problem? Because so far we've been able to push that out because it hasn't actually taken effect yet.
How have you seen corporate America mitigate some of those concerns?
I think people look at sourcing. I think people look at a variety of different things that they can do to say, okay, if this is going to cost me 15% more, what else can I do to either change that, and or maybe I'm not hiring so many people, because in the end, what is the flex that you can do in your variable cost? Sometimes it's labor. Sometimes it's not some of those components that are fixed. So to the extent that you can't resource something in the States that you were buying somewhere else, or do something that's cost efficient that way, I think the problem is that then that becomes a labor question.
There is a bull case in big tech, and there's a bull case in some of the puts that are out there, that still are out there, even if some people are saying that maybe they are less potent than they were earlier this year. And one of them is central banks around the world. And we just saw that with the Bank of England cutting rates despite some of the inflationary pressures, because their economy is weak and actually showing real signs of weakness. In the United States, we've heard something similar from some of the Fed officials, even though there still is that risk, especially with CPI on the table next week, that there really could be this inflationary pressure. So how much is that sort of a tailwind for risk assets? Because either there's going to be weakness and there'll be a response from a central bank, or there won't be weakness and then you can just carry on with these kinds of gains.
Well, and I think that that's sort of where the Fed's been able to hedge its bets and say, we're going to wait and see, and we're going to wait and see, because the economy has been kicking along. Things have been going well. Earnings have been coming in. And that is one of those conundrums that either you're stuck because you can't do something, or no matter what happens, it's going to be okay. And I still think we don't know, but the market is priced for it's definitely going to be okay. So any wobble in that story, as you see we've watched those narratives flip back and forth for the last couple of years, any change in that story, and I think you could see some, if not prolonged weakness, certainly some volatility that nobody wants to ride through in August.
Well, earlier, about an hour ago, actually, we were speaking with Ben Laidler, and he said he doesn't like the United States right now. He actually likes the rest of the world better just because of valuations and people not factoring in some of the slowdown that you're talking about. Do you agree that the rest of the world looks better?
That's a tricky thing for me because at the same time, the U.S. has to do well for the rest of the world to continue to do well. So if the U.S. is looking shaky, then I'm not sure that I can handle, or that I can say that it's much better to be in other places, because there's going to be a knock-on effect. If the U.S. slows down, everybody else is going to slow down. But from a straight-up valuation point, that's hard to argue because the U.S. is valued at a very high level right now. And that's part of the problem, is that some of those valuations seem much more ephemeral and .com-like, and that is what I think is worrying investors in a general way.
What Ben Laidler was talking about reminded me of what Mark Rowan of Apollo said in May, which is basically like there's been a brand hit to corporate U.S. America Inc., and he sees the U.S. moving from hyper-exceptionalism to just merely exceptional. Would you agree with that? We're just not as exceptional?
I think that's trying to fine-tune something that is either a yes or a no as opposed to a gradation. I think that from a technology and an innovation standpoint, it's still hard to beat the U.S. markets, which is why the U.S. technology market is doing so well and will continue to do well. I think I have a hard time parsing out that much of a difference. I think it's still the U.S. is going to continue to do well. Other markets will do well. The U.S. starts to slow down. I think that's going to be a problem for other markets as well. It's hard for me to separate those two.
Sarah Hunt, thank you so much for being with us. Sarah Hunt of Alpine Saxon Woods on this Thursday. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump's new country-specific tariffs have taken effect. According to Bloomberg Economics, Trump's actions will push the average U.S. tariff rate to 15.2%, with some countries facing duties as high as 50%. The president says the higher levies will slash trade deficits and push companies to move manufacturing to the U.S. Meanwhile, President Trump and Russian President Putin are set to meet in the coming days. The Kremlin confirming the two sides have agreed on a venue. Talks had been initially considered to include Ukrainian President Zelensky, who posted on X this morning that various peace meetings have been discussed with German Chancellor Merz, including 2 bilateral and 1 trilateral. And take a look at Eli Lilly shares. They are sinking 13% as disappointing data on its new weight loss pill is overshadowing a strong second quarter. Lilly beat on both the top and bottom lines, and it raised its full-year revenue outlook. It now expects to bring in $60 to $62 billion this year, with its obesity treatments continuing to drive growth. But quite the plunge this morning. That's Bloomberg Brief. Lisa?
Thank you so much, Yahira. Evidently, in Lilly's pill study, patients in the highest dose lost about 11% of their body weight, or 25 pounds, and people were looking for maybe 15% of their body weight. That's essentially what people were talking about.
Well, potentially they're going to get there, right? The science just keeps getting better. But a little concerning, though. That's a lot of weight to lose in a short period of time.
Well, this was last year's story. Maybe we're all getting back to fast food this morning. Up next, piling on levies.
You know, we put a 50% tariff on India on oil. You're going to see a lot more.
So this is a taste of
You're going to see a lot more. You're going to see so much secondary sanctions.
Former NEC Deputy Director Everett Eissenstat joins us next. It was supposed to be D-Day. It was supposed to be the deadline for all of the tariffs to go into effect. A lot of concern about what this would mean for businesses. Let's take a look at markets and see all of that concern, and markets are up. They're retracing some of the gains from futures. Now just up about 0.6% for the S&P, really led by big tech, and you could see that with the outperformance in NASDAQ. Yields creeping just a touch higher. A focus today on the 30-year auction at 1 p.m. Yesterday's 10-year a little soft. 424, up about 2 basis points, and crude prices just slightly higher, $64.81. Under surveillance this morning, piling on levies.
You know, we put a 50% tariff on India on oil. They're the second largest. They're very close to China in terms of the purchase of oil from Russia.
Why are you singling India out for these additional sanctions?
It's only been 8 hours. So let's see what happens over the next.
Sanctions.
You're going to see a lot more.
So this is a taste of
You're going to see a lot more. You're going to see so much secondary sanctions.
Here's the latest. President Donald Trump threatening additional levies on countries purchasing Russian oil as his country-specific tariff rates take effect. Bloomberg's Tyler Kendall joins us now. Tyler, what's the latest on why India has been pinpointed as the first to really underscore this effort to use tariffs in a negotiation with Russia?
Yeah, hey, Lisa. Well, it's clear that the president hasn't been too happy with India when it comes to the trade talks, and it looks like this is perhaps being used in leverage for those negotiations, considering that India really saw a reversal in fortune when it came to the discussion since the country was long prioritized. We saw Prime Minister Modi be one of the first foreign leaders to come to the U.S. In fact, India actually put a whole lot of concessions on the table pretty early on. You'll recall they lowered tariffs on an array of goods from luxury items to motorcycles, yet they still ended up with this 25% tariff rate. Now, President Trump, though, said that India is really just the start here, which leads us to questions on which other countries could get these so-called secondary tariffs. The president did say potentially China could be on that list. And while we did hear the Treasury Secretary Scott Bessent last week in Stockholm say that he warned China against importing sanctioned oil, we're starting to see some top advisors really downplay that idea, including senior trade counselor Peter Navarro, for example, considered to be rather hawkish, saying yesterday that he doesn't really think that the tariffs are going to be ratcheted up that much higher. One of the main reasons being that Beijing would likely retaliate. And at this point, both sides are just trying to keep this de-escalation in place, though China is the leader when it comes to importing Russian energy supplies. They represent 47% of Russian oil exports, followed by India at 37% and then Turkey at 6%. But Lisa, at the end of the day, our analysts at Bloomberg Economics say that when it comes to India, those barrels are just going to be diverted into the market elsewhere, which really means that this administration is likely looking at some other economic penalties when it comes to forcing Russia to the table. We had our Bloomberg News reporting yesterday, according to a person familiar, that the White House is looking at adding new sanctions on Moscow's covert fleet of oil tankers, and that potentially could be on the table next.
Bloomberg's Tyler Kendall, thank you so much for being with us. Joining us now is former NEC Deputy Director Everett Eissenstat. Everett, thank you so much for being with us. I want to just start with what we know today in terms of the tariffs that have gone on, the details of that, and what's to come over the next 3 weeks.
Well, this is a really big day. You know, the president has been signaling these tariffs on the way for, well, since he was elected on January 20th with his America First trade agenda. And he's put different measures to kind of tease out the rates and different methodologies using different statutes. And now we've come to the place where today they're actually going to go into effect. And we know what the tariff rates are going to be on the reciprocal tariffs for particular countries. You have some of them up there. As you noted, they range from 15 to 50% and for different purposes. We also have a number of the sectoral tariffs in place, in addition to investment commitments from some of our trading partners. So there's a lot of the president's trade agenda that is now in place, including the framework agreements. Now, the framework agreements are going to be a guidepost, really, about how to move forward with these economies. They're not perfect. They need continued negotiation, but they do demonstrate directionality. So I think we've got a bit more clarity than we did a few months ago, and we really have now see what the president's agenda is going to look like in operation.
Everett, when it comes to the president's agenda, though, there's two countries that it does seem like they're still in negotiating mode, India and Switzerland. Do you think we're going to see those rates come down?
I do. Certainly with Switzerland. I look at the U.S.-Swiss relationship, and it is so interconnected, and we're such important allies. I think the Swiss were a bit shocked, candidly, at the rate. I don't know if that was just a botched negotiation or how they ended up in one of the highest rates in the world. Of course, a lot of it has to do with the trade deficit and how the president sees that trade deficit. But there's a lot that we share with Switzerland, particularly on intelligence and things of that nature. So I think that one, it will come to settlement at some point. In fact, they were in Washington yesterday seeking to find a framework deal. India is a much, much more complicated equation. That one, as was noted, was started out with such a great dynamic between President Modi and President Trump, and really has deteriorated. And if anything, they've become more polarized over time and almost every day.
When it comes to India, is the president basically putting geopolitical priorities in terms of Russia ahead of some of the economic priorities?
I think it's a combination of both. And if you noted that the secondary sanctions, which are a new concept that the president actually authorized himself to deploy, not just against India, but other countries yesterday, are being used on India, not China. So I think it's selective, but I think it's a tool that he will use. And when he feels like a relationship is not moving in the right direction, he'll use every tool he can to get leverage. And if it's a geopolitical reason, then that's certainly a valid reason to do that. So I think it's a combination of factors. It's going to take some work and time to rebalance that relationship. I don't know that it's going to happen soon, but we're definitely going to have to watch. And of course, the secondary sanctions, as noted, new tool could have new dynamics for other economies. So that's going to be an important concept that we'll need to keep our eye on.
Everett, does it sound like something that is going to be used with China? Is that sort of the objective here, not only to pressure Russia, but also to put this on the table ahead of some sort of Xi-Trump meeting to say we could go there too?
It could. I mean, we tried that, right? The president put prohibitive tariffs on China. It didn't work out so well. It really was incredibly disruptive, and China responded by withholding exports of materials that were needed for manufacturing in the United States. So I'm not sure they want to go there again that quickly, but the fact that the tool is there is definitely a signal, and we'll see how the relationship between the U.S. and China unfolds. The president wants to get to a place with China where we can have a more productive relationship. I think that's clear. He's moving in that direction. I think putting sanctions on China, secondary sanctions, would not lead to that goal. So I don't expect that to happen in the near term. On the other hand, he is meeting with Russia. And so in many ways, these sanctions could be as a message to Russia as much as they are to India and China. But again, new tool, it's unprecedented. This president has used tariffs in ways that couldn't have even been imagined really prior to his election. So I'm sure there's a lot more creativity there. And it's something, that's going to continue to be a factor, even though we've got a lot of the central elements of the president's trade agenda in place now.
Everett Eissenstat, former NEC Deputy Director, thank you so much for being with us as we do look through the more than 15% rate and understand what exactly the ramifications will be for the U.S. economy. Still a lot of question marks, including all of the exemptions that could potentially be put in place for auto manufacturers, for example, in South Korea.
You have to look at all the fine print when it comes to these trade deals, because there will be carve-outs and there will be exemptions, which is giving basically the market some breathing room and looking through some of, okay, this isn't the worst case scenario, even though the baseline for a lot of countries is 15%, not the 10%. What's so interesting about China and India, and Heidi Rediker brought this up yesterday, the Wall Street Journal editorial board, the top of their opinion piece is talking about it today. Trump is going after India, but for decades, Republicans and Democrats have been courting India to be a counterweight to China. So this is one way he's using geopolitics, try to benefit one situation when it comes to Russia's invasion of Ukraine, but does it hurt the administration when it comes to that counterweight to Beijing?
Which is what some people are arguing. We're also seeing the president this morning out in Truth Social talking about the way we measure the population in the United States, saying, I have instructed our Department of Commerce to immediately begin work on a new and highly accurate census based on modern day facts and figures, talking about what information was gained during the prior presidential election, talking about how people in the country illegally will not be counted. A real question here about whether some of the economic data is going to be increasingly politicized.
I knew you were going to go there because you have been on this correct rant about how we should have better data. Partially, a lot of people would say to have better data, the Trump administration needs to lift their own hiring freeze so that they can get more statisticians in the BLS.
We're going to be talking more about that and what the ramifications are for corporate executives with the CEO of Hyatt Hotels. This is next. Markets digesting the tariffs going into effect today with ease. You're seeing futures push higher throughout the morning, off earlier highs, though. Throughout the morning, just losing a little bit of steam, up 0.7% on the S&P. Russell 2000 climbing more than 1%, as there is currently a 95% chance of a Fed rate cut in September. And NASDAQ certainly leading the charge after a lot of people saying that the semiconductor tariffs were less than some of them had been expecting. 2 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Eli Lilly, the latest company to report results, but shares are plunging 9.5%. But it was not because of the results. Those were solid. It's because just ahead of those earnings, we got data from its latest obesity pill trial, and it came in short of expectations. On average, patients lost 11% of their body weight. Investors were hoping for weight loss of 14 to 15% in order to match Novo Nordisk's shot Wegovy, but their hopes have been dashed and they are punishing the stock for it. Moving on to tech. Look at all these companies rallying on the back of Apple's announcement that it will invest another $100 billion in U.S. manufacturing. Apple up another 2.75%, Corning up 4.3% because Apple plans to invest $2.5 billion in its longtime glass producer. And now all glass used in Apple products will be made in the U.S. Meanwhile, Global Foundries, a chip manufacturer, also rallying 7.8% because it is another Apple partner doubling down on U.S. production. And sticking on tech, we have TSMC shares. They are rising 5.5%, trading at record highs after Taiwan confirmed that the chip maker will be exempt from Trump's proposed 100% tariffs on semiconductor imports, thanks to its massive investments here in the U.S. Because like Apple, it too made a splashy announcement at the White House, and it made that announcement all the way back in March before the tariff chaos of April even started. So in hindsight, I'm sure they're very happy with that early move. Lisa?
Thank you so much, Yahira. It does seem like you have to look at the fine print, given 100% tariffs with a big but after about who's exempt.
Exactly. And then you look at, okay, who's exempt? It's pretty much everyone, which is the market is like, great, we can rally on this news. It doesn't mean anything. Shock and awe is what comes out of the Oval Office, and then you take a step back. Okay, there's a ton of exemptions. We're fine.
Well, we have to look at the fine print for this. On our radar this morning, President Trump's new tariffs officially taking effect this morning. Bloomberg Economics estimating that the average U.S. tariff rate is more than 15%. That's well above last year's 2.3% and the highest level since the World War II era. A real question of how much we've already seen companies adapt and adjust, and how much, to use Ben Laidler's phrase, this is boiling the frog.
Well, for Ben Laidler, he's basically like, I don't want to touch the United States right now because they are weakening and these tariff rates are going to make it incredibly more challenging. And you can get better results elsewhere, especially when it comes to high valuations. But then we heard from Kelsey Berro, who's like, our team did the research. We did 10 to 20% on tariffs. And the bottom line is it will hurt earnings a little bit. It will crimp them a bit. But for the most part, companies in America will be fine. What I find interesting about today is that this does feel like for most countries, and you put it best at the top of the show, for most countries, this is the new rules of the road. These are the new tariff rates. But there are still some that are working out of the administration a potential deal. So I think what's going to be interesting in the next few weeks, what do we see out of India and what do we see out of Switzerland?
That's the negotiation side. I'm curious about how much companies are going to increase prices. Not necessarily have they already, but are they going to? Elf Beauty and commentary yesterday, just as an example, saying overall retailer acceptance has been good for our price increases, and saying you will probably see more companies take pricing upward. Meanwhile, we're watching Apple shares getting more expensive. Well, those prices are rising after the company unveiled plans to spend another $100 billion on domestic manufacturing. President Trump promising to exempt companies that move production back to the United States from his 100% tariff on chips. A real question here, how much of this investment was already planned? How much of this investment is actually new on top of what had already been discussed?
Well, the majority of it was already planned. They just sweetened the deal a bit more and get a higher number. Also, this is going to take years, if not decades. So potentially will we see all of this actually come to fruition? But it was enough for Apple to get an exemption. And we saw Tim Cook do this in Trump 1.0. What do I need to do to make sure I can get a carve out? What is interesting, and Yahira brought it up, this Corning leading the Apple suppliers higher this morning, They are basically saying Apple at some point will 100% have the glass that covers your Apple iPhone or your Apple Watch made in the United States. At the end of the day, that is what the president wants to see. He wants to see a carrot and stick approach when it comes to this tariff policy.
He also wants to see lower rates. President Trump signaling he will nominate a temporary Fed governor to fill the open seat vacated tomorrow from Adriana Kugler, saying he's considering, quote, probably 3 candidates for the position, adding they could come from Wall Street. We all come from Wall Street, he said. A real question here about why a temporary Fed official? What would be the role if someone knew they only had a couple of months before they would be replaced?
So I broke this story with Saleha Mohsin yesterday, and the president basically confirmed it. We're looking at this temporary option, and you have to think, who wants to do that? You basically leave your job for 4 months. I think there's 2 paths to look at it. One, is this a temporary option as a trial period for someone to see how they do? Does the president like this individual that potentially could get either the full nod to have a seat at the Fed or become the new Fed chair? Or is this someone that is overtly political? The president just wants to send a message right now. He does love a little bit of drama, potentially wants to send a message and get someone that is really brought up through the MAGA base. Someone like we talked about earlier, a bit more of an unconventional pick when it comes to James Fishback.
Talking about maybe cutting rates by 100 basis points in September. The question about how much this will actually ripple through the economy is an important one. Turning to the travel industry, Hyatt reinstating its full year guidance after its second quarter earnings beat estimates. Bloomberg's Danny Berger joins us now with a special guest. Danny.
Lisa, thank you so much. It is such an important earnings season for just that, understanding the consumer and their sensitivity to this economy. I'm pleased to say joining us now is someone who understands the consumer very well. It is Mark Hoplamazian, the CEO and president of Hyatt. Mark, thank you so much for joining this morning. You're out with earnings moments ago. Earlier this year, you had to cut earnings because of your outlook on some of the weaker reservation trends going forward. You've mostly held on to that look. So what, if anything, has changed for the consumer and the demand you're seeing?
Well, Danny, first of all, thanks for having me. The first point that I have to make is that travel is extraordinarily resilient. It's become a necessity for both leisure travelers and for business travelers. The second quarter was a weaker quarter for business travel, but leisure held up really, really strongly. And our U.S. resorts were up mid-single digits for the first half of the year. Europe was up almost 7% in leisure. So it's leisure, especially in the luxury segments, which luxury has been up about 6 or 7% year to date as well. The higher end customer, which is our core customer base, with 70% of our portfolio in luxury and full service, is alive and well. So I would say a couple of things have happened right now. The first is that our largest corporate customers have told us they're going to lean in and continue to travel. And they're making more commitments, especially for customer-facing events and meetings. The second thing that happened is that we saw bookings for 2026 really improve for big group meetings. And third, the Conference Board and the Business Council released their CEO sentiment survey this morning, and things have turned. Now tariffs and volatility have declined to number 3 on the list from number 1. And their outlook with respect to potential recession has dropped dramatically. So I think the attitude and mindset for a lot of CEOs is shifting.
Mark, that's very fascinating because the tariff picture is still evolving as we go on. So are there any pockets where you're still seeing those fears of economic anxiety? Or to your point, is it now confidence restored?
No, we are. And in a word, it's China. The caution and conservatism in China is clear, and a lot of people are uncertain about what a so-called tariff war or the tariff picture might do to the economy overall. There's an increasing, I think, body of thought that says that Beijing pays a lot of attention to sentiment. And the sentiment is definitely one of very significant caution right now. So I think there's an expectation that sometime in the fall, there may be policy shifts that alleviate some of that and bring back a stimulus for growth. So I would say,
if I could just jump in, because I wanted to get to luxury, because you mentioned that this is one of the strong suits and really resilient. Of course, you've doubled down on the luxury strategy, too. but it is a time where there is more competition, and maybe that aspirational traveler needs a little bit more convincing that they should be paying up for the $1,000+ a night type of all-inclusive resort. So what do you need to do in terms of strategy to convince them that paying up is worth it?
Well, our all-inclusive business is up 6 or 7% year to date, 8% if you include Europe. It's been wildly resilient. We are the leader in 5-star luxury all-inclusive resorts. I think the certainty of what your vacation will cost you and the experience on property where our colleagues are not thinking about or engaged in how much something costs, but rather full-on human-to-human service makes a difference to people. And so the format is really, really proven to be very, very popular and will continue to do so. We just closed on the acquisition of Playa Hotels and Resorts, 2,600 new hotel rooms in premier beachfront locations. And we have a deal to sell all the real estate, so we will maintain our asset-light status. It's a great deal and adds $65 million in new fees to our run rate. So I think we're quite pleased with that. So we're definitely doubling down on luxury, and we're definitely doubling down on all-inclusive.
Well, Mark, just to that point, it's been a really hot summer, a really hectic summer. I think a lot of people are looking for inspiration of where to travel right now. Where is the most demand? Where are you seeing most people go to? What's in fashion right now?
Yeah, I would say the U.S. traveler has headed to Europe this summer. We thought we would see a massive decline from last year, given the Olympics and Taylor Swift, but they're back in Europe, and Europeans are staying in Europe. But I would say the diversity of destinations has increased. A lot of interest in Central and South America. And the Caribbean and Mexico continues to be in great demand, both amongst Europeans, and the Canadian volume into our Mexican and Caribbean resorts is significantly above last year. A lot of people have talked about the flyover effect, where Canadians are heading over the U.S. to get to Mexican and Caribbean destinations, and we're seeing it significantly.
All right, so Europe staying in Europe, Canadians skipping over the U.S., definitely a trend there. Mark, thank you so much for joining us this morning. Mark Hoplamazian, the CEO of Hyatt. Lisa, you are seeing a rebound in business travel, but China remains a weak spot.
Yeah, that's something that has been a theme for a number of U.S. companies. Danny Berger, great work. Thank you so much for that. Right now, we are getting another Truth Social. It is an active morning for President Trump on Truth. He is saying the CEO of Intel is highly conflicted and must resign immediately. There is no other solution to this problem. The CEO took over from Pat Gelsinger, and what we are seeing is the shares with an immediate knee-jerk reaction, pre-market trading, futures lower by now 1.5% as people try to understand what exactly the ramifications for this are, what the motivation for President Trump's tweeting about this morning. And this just continues the theme that we've seen, Annmarie, that you do see a response in stock markets on the heels of a lot of these pronouncements.
Well, on the motivation front, what we saw yesterday, Reuters report, an exclusive report, was that also an ally of the president in the Senate, Tom Cotton, sent a letter to Intel questioning the new chipmaker CEO. He's been in office, as you said, for a year, about his connection and ties to Chinese firms. And that seems to be a concern, at least from some senators, Republican senators who are very hawkish on China. Maybe the president is getting a little bit of briefing from them and wants to air this out. He's not explaining what his issues are, but when he says highly conflicted, it seems to be talking about this letter that Senator Cotton sent to Intel.
Yeah, and a real question about what this means with respect to tariffs and whether they get targeted with something more substantial. We'll follow that story this morning. Is it just a Truth Social post, or is there some sort of oomph behind it to try to penalize the company until there is some sort of changing of the guards? Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump declared plans to slap a 100% tariff on semiconductor imports, but promised to exempt companies that move production back to the U.S. Trump shared his intentions alongside Apple's Tim Cook, who announced plans to invest an additional $100 billion in domestic manufacturing. Meanwhile, Switzerland's government is holding an emergency meeting today to consider the fallout from President Trump's 39% tariff rates. This after President Karine Keller-Sutter failed to make a trade deal and avert the highest U.S. levies on any developed country. The Federal Council will issue a public statement after the extraordinary meeting. Meanwhile, shares of Warner Bros. Discovery are rising 2.3% after the media giant reported earnings that beat estimates. The company also topped total subscriber expectations, adding over 3 million new subscribed viewers in the quarter. Its studios unit has been on a Hollywood hot streak, with revenue rising 55% to $3.8 billion. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, looking for the next rotation.
We see a broad rotation out into everything else. You're starting to see it already. The overall market's really not that expensive. We think it's the rest of the market where there's value.
Mike Pyle of BlackRock joining us next. This is Bloomberg. If you came into this year on April 2nd and said a lot of those tariffs would stick and that we'd be looking at more than a 15% average tariff rate across the board, you would probably expect stocks to really be having some issues digesting this. Right now, you're seeing futures up pretty much across the board, 0.6% gain on the S&P. You're seeing a bigger gain on the Russell 2000, more than 1% on the futures. Dollar weakness has been a theme. You are seeing that reverse just a touch today. And yields just continuing to creep higher, but still hovering around that 4.25 to 4.50 level. Today, they are 4.24. Tomorrow, we do see potentially the ramifications of a 30-year auction later today. Under surveillance this morning, looking for the next rotation.
The next 12 months, we see a broad rotation out into everything else. You're starting to see it already. The overall market's really not that expensive. Once you take out the Mag 7, which are kind of special, exceptional companies globally, right? You take them out, the rest of the market's trading around 19, 20 times. We don't think that's an unreasonable level, and we think it's the rest of the market where there's value right now in the market.
Here's the latest. Traders continuing to buy the dip, with the S&P 500 up nearly 1% after a slide on weak ISM data earlier this week. Mike Pyle of BlackRock writing this: "We do not believe this is an environment for taking big bets on macro trends." Mike joins us now. Mike, a lot of people would agree with you because that has been definitely a pain trade. We have seen, though, even in the micro space, some pain trades with respect to the huge moves after earnings, as well as some policy pronouncements like we're seeing this morning with Intel. So how do you find an advantage in a market that is so bespoke and idiosyncratic?
Yeah, I mean, I think a key word for investors now and always is diversification. That's true when you think about asset allocation. It's also true when you think about alpha. And I've been on this show a couple times, talked about some of the advantages of systematic strategies. One of those advantages is they've got a bunch of different strategies, a highly diversified set of strategies to harvest alpha from new sources of data. And in a world where there's a lot of uncertainty, where the macro trends could go in a bunch of different ways, finding sources of alpha where there are a lot of them, where they're well diversified, allows the greatest probability of harvesting consistent alpha over time.
What you just said there, harvesting different data sets, how much is that of renewed importance? Is there real questions around the integrity of some of the gold standards that so many market participants have relied on?
Listen, I don't envy the job of the official statisticians these days. The world is complicated. It's being buffeted by a lot of shocks, and they're having to do their jobs in a world where, survey response levels are way down. You see that challenge in political polling. You see that challenge everywhere survey data is important, and you see it with the official statisticians as well. One of the things we do in BlackRock, and again, particular around some of our systematic efforts, is really look holistically at a full range of alternative data sets that zero in on things like how are prices moving in the economy, how is hiring moving in the economy, to try to provide a more holistic picture beyond just the official sources of data. And importantly, where you see divergences between those alternative sources of data and what the official data is saying, that can be a source, a signal to identify alpha over time as well.
You worked on both Pennsylvania Avenue and Wall Street. What would be your advice to get better data out of the government?
Listen, I think the important thing is to continue to have a credible, independent process for generating official data. At the same time, I think, like I said, I don't envy them their job. I think that this is a really challenging world where the traditional methodologies are increasingly under challenge. Again, not just within the official data keepers, but really anywhere in the world that's using survey data. And so maintaining both a credible independent process, but also one that is given the space to update itself methodologically, thoughtfully, rigorously. And I think that's the path ahead.
When it comes to policy in Washington, are you surprised by how sanguine the markets have been to some of these higher tariff rates and certain trading partners?
I think we talked a bit about this last time, that markets right now, the economy right now, I think requires holding a couple of different divergent thoughts in your head at the same time. On one hand, tariffs are a source of uncertainty. Tariffs are a source of a negative growth shock, a shock in terms of the price level higher. We're seeing that now play out on the data. At the same time, on the flip side, the U.S. and in particular U.S. corporates in the technology sector are the world's leaders in innovation, dynamism, provide investors around the world exposure to something that they can get nowhere else. And so I think when you look to square what we're seeing in markets with what we're seeing in the economy, that's kind of the source of, or the key to unlock it. That, yeah, this is a shock where growth is lower and inflation is higher, but it's also the case that there's incredible dynamism and investors want exposure to that around the world.
Well, to something that you just said, you said inflation is higher. And this is something that a lot of people are rejecting. They're saying that the weakness that's going to come on the heels of some of these tariffs, these are going to act as constraints to the market and to growth, and that will be disinflationary. You don't really see it that way. And that's one of the reasons why you don't see bonds as the same kind of diversifier as they have been in the past, right?
Yeah, I mean, I would say, both these things are true, that this is a shock higher with respect to the level of the price of goods. That's playing out and will play out. At the same time, there will be disinflationary impacts that spread out over time as growth is lower and demand is lower, in part because of what we're seeing. So on balance, I think folks are right who say, these two forces are kind of counterbalancing one another. What I would say is there's an issue about how this plays out over time. The impact on goods happens in the here and now. That impact on disinflation from lower demand plays out over quarters and years. And so I think that's important to keep in mind as well. But I think you're also exactly right that, we don't see the same role for bonds as diversifiers. That said, as Rick Reeder, my colleague, has talked about, this is a really historic opportunity to generate income through fixed income assets. And so identifying your sources of diversification elsewhere, like through market neutral strategies, while recognizing that fixed income can play a role in generating income and income in a historic way, that's maybe the role of fixed income right now.
Mike Pyle, thank you so much for being with us this morning. Thanks. Mike Pyle of BlackRock there. As we try to understand exactly how market participants are spending their August amid a slew of headlines that most people seem to be looking beyond.
Well, we know one thing they're doing. They're ratcheting up these bets that the Fed is going to cut rates in September, because before that jobs report, it was at 40%. Now it's at 95%. And you see other members of the FOMC lining up with the double dissenters and saying, maybe it is time we have to actually cut interest rates.
By 25 basis points, not by more, which some people would argue would be necessary, particularly on Pennsylvania Avenue. Coming up, Kate Moore of Citi Wealth, Tom Forte of Maxim Group, Seema Shah of Principal Asset Management, and Tom Orlick of Bloomberg Economics. As they build this conversation, what is the new neutral rate? What is the right rate of inflation to expect in the future? This is Bloomberg Surveillance.
The market's moving more on headlines than it is actually on data.
You can't underweight tech. You still have to be where growth resides.
The tech AI spending is the juggernaut that's empowering this market higher.
The next 12 months, we see a broad rotation out into everything else.
There's some concern right here where we are, but people want to be invested in this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we wait for jobless claims in about a half an hour time. Lots of tariffs across the board. Tariffs, and markets are taking it all in stride. Meanwhile, a rate cut from the Bank of England putting the focus squarely on Fed officials as we hear an openness from more U.S. policymakers to potentially cut rates in the next month. A real question here about how much this market really is absorbing the tariff threat.
Well, right now, they've been absorbing the uncertainty, and now companies are going to have to look through, see the actual rates that come into effect. They are now going to come into effect officially for a host of these countries, unless a few are still negotiating with the United States. And they're going to have to figure out how are they across their supply chain going to be able to digest these rates. And what Kelsey Berro said is that they did the model 10 to 20%. It might hurt earnings a little bit, but it's not going to completely destroy corporate America, which is why the market is just looking through this.
And that's the reason why you are seeing futures pushing higher as we do wait for the jobless claims. A real focus right now on just what the economic ramification does look like. Right now, it looks like big tech will save all, and the Russell 2000 gaining on the prospect of rate cuts. But the labor market report that we got on Friday, then the stagflationary type of ISM services data really puts a spotlight on some of the downside surprises that some people have been worried about.
Jobless claim is going to be really important today, given the fact that we heard from Lisa Cook yesterday, talking about the fact that she is uncomfortable with what's going on in the labor market. She finds it concerning. Quote, these revisions are somewhat typical of turning points. Also, Neil Kashkari, we have to be cutting in the next few months. Well, you don't have a ton of months left. We're 6 months left for the rest of the year. And the market is pricing in 95% chance of a cut in September. And more individuals are now starting to line up with Governor Waller and Governor Bowman.
Yeah, and a real question about exactly what a temporary Fed member might look like to replace
Lots of
Adriana
questions about that one.
in terms of what that person's role actually will be. Right now, we have been seeing in markets a calm, a little bit of yields higher, particularly on the long end after yesterday's 10-year auction. Later today, we do see a 30-year auction of Treasury notes as people wonder how willing international investors will be to keep coming to the United States. Right now, yields 2 basis points higher on the long end, 10-year yields 2.5%. Coming up this hour, Kate Moore of Citi Wealth as markets digest President Trump's latest tariffs. Tom Forte of Maxim Group as Apple reaches a deal with the White House with great fanfare yesterday. And Yelena Shulyatyeva of the Conference Board reacting to the latest read on the U.S. labor market and maybe some alternative sources of data as people wonder about how much you can glean from some of these indicators. We begin with this hour with stocks higher as sweeping new tariffs come into effect. Kate Moore of Citi has been cautioning people recently, writing this: we view newly announced tariffs as a headwind to further equity upside. We are moving to a new phase of policy and trade uncertainty. Kate joins us now. Kate, thank you so much for being with us. You've been cautious. You've been cautious for a while. You're still cautious. What makes you hold on to this position, even though a lot of people have been saying it's a pain trade?
Yeah, so I mean, we need to separate this out. I have been cautious, concerned with some of the policy headwinds, with some of the challenges that individuals have in terms of making spending decisions. That doesn't mean we've been underweight equities. These two things are not the same. We've been neutral weight equities, but we prefer to express our view, up in quality, like a lot of people, and more concentrated in the kind of the mega caps and the secular growers. So if I felt really, really like we were going to be in an accelerating growth phase, I'd be rotating more into the small caps as something more than a trade and into a kind of an investment. But that's not it. So my caution expresses itself in more of a neutral weighting and a bias towards high quality and a bias towards large caps.
Although there is this issue of valuation at a time when everybody's been hiding out in this. So at what point does that become a concern for you, given the fact that everyone's hiding out in these mega caps and big tech has been the story yet again of the year?
Lisa, I would be a little bit more concerned if the companies didn't put up good numbers in the second quarter, right? Multiples can stay high for extended periods of time. They can stay cheap for extended periods of time. And we're in an era where a lot of information gets priced into shares very, very quickly. So, there's this mispricing that maybe some of us grew up with in earlier stages of our careers is less likely to persist. And things are expensive because they have secular earnings, because they have an ability to grow through all parts of the economic cycle, because they're in the fastest rivers. This is, I think, justified for some of these mega caps, even if I look at some of these numbers and, like many people, feel a little uncomfortable.
Everyone on the street is talking about how they want to be a buyer of the pullback. Well,
oh yeah.
When's the pullback?
How big of a
catalyst?
pullback can we get in that environment? I think that's right. We've looked at, seasonality like everyone else and said August and September, weaker times. We tend to get some of these air pockets. I have perhaps a little bit more cautious stance on some of the tariffs that hit today. And this is what I would say. Everyone's saying if we get a 5% pullback or a 7% pullback, they'd go all in. They'd back up the truck. The problem is that no one's going to wait for those levels. I think these pullbacks are going to be quite shallow, even if we get a decent amount of volatility through what is normally a seasonally weaker period.
The uncertainty around tariffs. On the other side of the coin, you are looking at potentially the incentives for the one big beautiful bill.
Yeah.
Are you starting to see that now actually take effect?
I don't think corporates really know how to guide us on this one. So I hear a lot of people say, hey, we're only talking about a 15% give or take, like effective tariff rate. It's not that much. Of course, we all know how much it is relative to where we ended 2024. But the bigger question I have is when people make these assumptions about it not having a large impact, how are they splitting the cost between the suppliers, the company, and the end consumer? And everyone has a lot of assumptions baked into why it won't be a big deal for XYZ company. So, and companies don't know what to say. They don't know how much they're going to be able to push. I think a lot of what's happened since the April 2nd tariff announcements has been companies have been eating some of this in their margins, or they've been spreading out costs across a variety of different products, or they've been holding off on investment, trying to fund as much of it as possible. But as some of these things get baked in for longer periods of time, there's going to be more durable impact on both margins and on the consumer. And frankly, I don't know either exactly what that looks like.
Do you think it's going to be worse in the U.S. than the rest of the world?
I think it's going to be worse I think it's going to be bad in a number of places. I will say that U.S. companies and consumers are going to feel the pain. I think we're at the very beginning stages of seeing some of the tariff impacts on goods prices. Whether or not that changes the consumption, or appetite for like the average household, I'm not sure. Or whether we see, as we've heard from some of the retailers, spreading out tariff costs across a variety of products that otherwise would not be directly hit, in order to make sure that people still come into the store and that we don't see a significant decline in retail sales.
Well, I guess I'm wondering how much of the dollar weakening story is really pegged to this ongoing belief that the United States is going to suffer the brunt of any kind of economic slowdown on the heels of tariffs. That's been challenged, certainly with some earnings, certainly with some of the rates that we've seen, as well as the commentary out of central banks. I mean, how much do you lean into that versus push back against it and say, hold on a second, when you actually look at the corporate earnings, they're still outperforming in the U.S. in a significant way.
Yeah. I mean, I guess, the conversation we were having in the beginning part of this year about the end of U.S. exceptionalism was really is really not going to play itself out in the equity market, in my view. If we get fewer buyers or fewer marginal buyers of, long duration U.S. bonds or people thinking about their currency exposures, that's one thing. But we still have to invest, if you're a global multi-asset investor or an equity investor, in the highest quality companies that are serving all parts of the world. And unfortunately, for those people that didn't want to own the U.S., many of those are U.S. companies.
If you think we're in the start of potentially the impact of the tariffs on inflation, what does the Fed do?
Gosh, I am so glad I'm not a Fed policymaker. This is an incredibly difficult time.
Well, what are you baking in? It's going to impact corporate America.
I think it's very likely that we will see some easing, but I think the Fed is in a really difficult place here. If they cut while the labor market is frozen but not deteriorating, right? I think we need to distinguish, and inflation is continuing to percolate. People are going to ask themselves, if the Fed is really anchored to this 2% target or getting to that 2% target, and we've been above that 2% target for 4 years, and the labor market is frozen but not deteriorating, can we believe them?
Do you think it's frozen now or deteriorated?
Well, we haven't seen huge layoffs at this point, right? Job recs not filled for sure. And we certainly see a lot of companies talk about slowing down their hiring. But from my perspective, I can't disaggregate how much of that is because of tariffs and economic uncertainty and how much of it is because the technology they're investing in may displace workers. I mean, these things are all happening concurrently.
Right now, you see a market pricing in 50 basis points of rate cuts.
Yeah.
If the Fed were to cut more this year, does that make you more bearish on longer-term treasuries?
It makes me cautious, I think, on longer-term treasuries. We have had a more cautious stance. I think it's very consensus for a lot of us in the multi-asset space to have been really anchored to the short duration. And we're all waiting for an opportunity to add to duration. I'm just not excited about it in the near term.
Kate Moore, thank you so much for being with us,
Yes.
as always. Kate Moore of Citi Wealth. Always wonderful to have her in studio right now. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump is urging the CEO of Intel to resign, saying in a Truth Social post he is highly conflicted and there is no other solution to the problem. The post comes after Trump's ally, Senator Tom Cotton, asked Intel's board chairman about the CEO's ties to China. Meanwhile, President Trump indicating he'll likely nominate a temporary instead of a permanent Fed governor to Adriana Kugler's soon-to-be vacant seat this week. Trump also reiterated that he considers the two Kevins, Warsh and Hassett, as top picks to replace Fed Chair Jerome Powell. Fed Governor Kugler announced she plans to vacate her role tomorrow. And President Trump met with Citi CEO Jane Fraser to pitch public stock offerings for Fannie Mae and Freddie Mac. Sources telling us here at Bloomberg, Fraser met with Trump to discuss the bank's possible involvement in monetizing the mortgage giants. The firms have been under government conservatorship since the 2008 financial crisis. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, the morning calls, plus Tom Forte of Maxim Group on Apple's return to the White House. Tim Cook back in diplomat form and seeing the share price up more than 5% yesterday with more gains ahead, at least in futures. This is Bloomberg Surveillance. You've seen these big moves in the stocks. They come in with really good earnings and everybody's like, well, the move's already happened, or that wasn't so much better than I expected that it's going to push it again further. So I think this is, to me, a little bit worrying because you want to see those good earnings be rewarded. But I think that the market just keeps moving sort of relentlessly higher, especially on the technology side. And those earnings better be able to fill into that. And I think that is a little bit more of a turn than we saw earlier in the beginning of earnings season. That high bar is definitely catching a lot of people's attention. That was Sarah Hunt of Alpine Saxon Woods. As we do see more gains across the board, futures higher, up 0.6% on the S&P, just fading slightly throughout the morning. You do see NASDAQ futures outperforming that in the Russell 2000. Really the big winner this morning. Yields a little bit higher on the long end. Yesterday's auction was a little bit messy for the 10-year. Today we do get 30-year yields. Dollar weakness, a little bit more strength actually after the Bank of England decision. We're seeing 116 on the euro dollar cross. Time now for the morning calls. First up, Morgan Stanley downgrading Caterpillar to underweight, citing a, quote, steady deterioration in its fundamentals. Those shares lower by 0.4%. Next up, Wells Fargo cutting its price target on Airbnb to $110, saying its growth bets will probably not move the needle. Those shares sinking after yesterday's earnings, down 7.3%. And finally, Bank of America raising its price target on Apple to $250, saying it's likely to gain market share as some products will likely be exempt from tariffs. We do see these shares higher in pre-market trading, almost 3% after yesterday's more than 5% gain on the heels of that announcement in the Rose Garden, as well as some of the discussions around 100% tariffs on semiconductors, but exempted for anyone who produces anything in the United States. Sticking with tech, President Donald Trump calling on the CEO of Intel to resign. The news comes after Senator Tom Cotton wrote a letter to the company's board about the CEO's ties to China. Bloomberg's Mandeep Singh joins us now. Mandeep, thank you so much for being with us. What do we know? I mean, how much is this something that's been talked about?
Well, I mean, clearly they have sent a letter to the board. And at this point, I feel like they'll look into what sort of investments he has with companies in China. I'm guessing it will be some sort of a minority investment. He's not involved in the day-to-day decision making, but clearly it puts the onus on the board to figure out, what they did do as part of the due diligence. And I think it's too early to say if there will be any action based on this.
Every morning, it seems like we have boards. Who's on the good list, the nice list, and who's on the naughty list when it comes to big tech in the White House? It seems like Tim Cook has really clawed his way back onto the nice list. Is Intel being on the naughty list essentially going to have some sort of material impact to its business plan, to its effects from tariffs?
I mean, when I look at, semiconductor manufacturing in the US, right now, Intel and Global Foundries are the two companies that are doing this at scale. And so the fact that Intel has been caught in the crosshairs, it kind of puts focus on the administration's plans to bring manufacturing home, because you have to revive Intel to really revive manufacturing, semiconductor manufacturing. And yes, Apple can talk about the CapEx plans and, multi-year investment, but even to start a fab, it's going to take 2 to 3 years. So they can start a glass assembly or, glass manufacturing maybe in 12 to 24 months. But for an advanced node fab, as we have seen with TSMC in Arizona, it takes a while. And so Intel, to me, is still the company that they need to revive to be able to say that, semiconductor manufacturing can take place and we can do this at the advanced node level.
Intel, though, did plead guilty for violating U.S. export controls, sending some of these semiconductors to a military university in China just last month. Do you see an emphasis now, potentially, on this administration to continue to ratchet up pressure with China when it comes to export controls? And what does that mean for a company like AMD, which is still trying to get licenses after the administration made a U-turn on the most recent export control in April?
Yeah, that's where the whole Section 232 comes into play in terms of the investigation that's going on. And look, I mean, it's very hard for an NVIDIA or Intel or AMD to determine who the end customer will be for their chips, right? Because, they sell in bulk. There's so many resellers in between that you can't really, even with location tracking, it's hard to see exactly who is using the chip and what's the use case. And so it's a hard problem to solve.
Mandeep Singh of Bloomberg Intelligence, thank you so much. As we watch Intel shares futures lower by about 3% after that Truth Social post by President Trump. We do want to turn to Apple, since its shares and how much they rose yesterday really drove a lot of the rally. The surge came after Apple committed to spending another $100 billion on domestic manufacturing. Joining us now, Tom Forte of Maxim Group with a hold rating and a 201 price target on the stock. Tom, thank you so much for being with us. I wanted to start with what we heard from yesterday. How much did you see this as a really bullish signal from Tim Cook?
Yeah, so when you think about Apple or just companies in general, you're trying to determine how can they mitigate risks as it relates to tariffs. And the good news for Apple from yesterday's news is that they're ramping their investment spend in the U.S., making themselves over time less dependent on China. They quantified the impact of tariffs once again when they reported the June quarter, projecting $1.1 billion incremental expense in the September quarter, and an increase from $800 million in the June quarter. But I think the reason the market's reacting favorably is that they're positioning themselves over time to be less dependent on China and then potentially have less of an impact from tariffs.
Less dependent on China because they did move a lot of the manufacturing as well and been trying to India. Are they now stuck in the crosshairs when it comes to this spat between India and the United States?
Okay, so the challenge for a lot of companies, including Apple, is many have moved their supply chain out of China, often into Southeast Asia, only to find that Vietnam's being tariffed at a high rate. So the good news for Apple in India is that they're focusing their assembly there on the iPhones being sold in the US and then using Vietnam for essentially the rest of their product set that's being sold to the US. The iPhones, for the most part, are exempt from tariffs. So were they to be assembling more than iPhones in India, then I think there'd be greater tariff risk to Apple in India right now.
When it comes to Apple announcing this an extra $100 billion in investment, how much of this do you actually think comes to fruition, and what timeline?
It's a 4-year horizon, and I think that it's going to take time for the factories to be built, things of that nature. And a lot of what we're talking about is Apple spending money with suppliers, and the suppliers are US-based. So if you look at CapEx for Apple, they talked about it increasing to $3 billion a quarter from $2 billion a quarter, but that's much less than Amazon that went to $30 billion a quarter from $25 billion. So a lot of this is Apple spending with its suppliers, having more of its suppliers US-based or sourcing from the US.
My head's spinning, Tom. Honestly, for a company like Apple, not only are they dealing with tariff threats, where they're going to manufacture the iPhone, but they're also dealing with artificial intelligence. How do they get a leg up at a time when Samsung is in some ways ahead of them? And then what do they do with their presence over in China, given that relationship between the U.S. and China is fraught and continues to be? How do you put this together? What is sort of the tell when it comes to Apple and whether they are moving forward with a longer term strategy to maintain the dominance that they have over the smartphone industry?
The historical performance of Apple has been fast follower. They weren't the first one with a smartphone. They were the best. It isn't clear that they'll be the best in artificial intelligence, but they are making steps. They clearly fumbled the football, but they're trying to address that. They talked about ramping that investment spend as it relates to artificial intelligence. We now have a new timeline for a revamped Siri enhanced by artificial intelligence next year. And surprisingly, they opened the door to potentially a large-scale acquisition to advance their efforts in AI. They hinted at that on the earnings call, which historically is not really something in their playbook. So they're trying to address AI to hopefully improve their situation over the next 12 to 18 months.
Before we let you go, Tom, if you put it all together, do you still see the U.S. as being dominant when it comes to the forward look of artificial intelligence and how quickly it's adapting into the economy? Or do you see, especially with some of these deals that are going into effect between the U.S. and China and internationally, other pockets of advancement, particularly in China, that seem to be superseding what's going on in the U.S.?
Yeah, so I definitely think when you step back for a minute, you look at OpenAI versus DeepSeek and things of that nature, it's certainly a very significant AI competition between the U.S. and China. It isn't clear today who will ultimately emerge as the winner. The good news for the U.S. is we have a lot of large multinational firms that are very tech proficient: Apple, Google, Meta, Amazon. So I think that bodes well for the U.S. in this long-term AI battle between the U.S. and China.
Tom Forte of Maxim Group, thank you so much for being with us as we try to understand the myriad storylines that seem to be filtering into the big tech story. The latest coming this morning with an investigation into Intel. I want to go back, though, to what Mandeep Singh said when we started the conversation. And he said, if you want to bring manufacturing back to the United States, you need Intel, given that it has the foundry, and it takes a very long time to build these.
It takes an incredibly long time, which is what we saw as well under the Biden administration with the CHIPS and Science Act, realizing how long it takes for even just some grants and incentives coming out of Washington to actually get to shovels in the ground. That is why there has to be things like exemptions, and that's why the market is seeing through this shock and awe 100% tariff rate the president announced yesterday for semiconductors. Because if you're investing at all in the United States, you're not going to have to pay that.
Apple shares in the pre-market up about 3% after yesterday's 5% gain as people look forward to those exemptions that Annmarie was just talking about. Across the board, you are seeing strength. Coming up, we're going to be speaking about U.S. jobless claims. That will be coming out in about 5 minutes' time. Yelena Shulyatyeva of the Conference Board will be joining us, as well as Seema Shah of Principal Asset Management, because really this is going to be the key data point heading into the weekend after ISM's stagflationary type of tone. Do we see that kind of weakness coming with the wrong kind of upside surprise in jobless claims? That's next. This is Bloomberg. "25 seconds until we get jobless claims. The key data point of the day as we look to see whether we do get confirmation of the unexpected weakness in last week's jobs report. Right now, we do see markets rising, futures higher, although off earlier highs. And notable, the Russell 2000 now up by just about 0.9%. You could see in the bond space a little bit of yields rising as people look to a potential inflationary pressure. Right now, let's head over to Michael McKee with those jobless claims numbers. The expectation is for 222,000. Mike, what are we looking at?
226,000, so very close at this point. It doesn't suggest any kind of massive layoffs are underway. There's been a big question about what's happening in the labor market, and obviously a lot of Fed officials made nervous by the low job creation last week. But so far, we're not seeing the converse of that. Companies laying off anyone yet. Continuing claims rise to 1,974,000 from 1,936,000. And last week's initial jobless claims headline number revised up by 1,000 to 219. So very much stable in that area. The other numbers out this morning, non-farm productivity rises 2.4%. That is more than the 2% anticipated. And it is after a 1.8% decline in the first quarter numbers. The 2.4% is a second quarter number, and it comes in after the first decline we had seen in non-farm productivity in some time. The issue here is important because there have been people suggesting, there's an argument being made that the economy can withstand a little bit higher inflation because AI is pushing productivity up. And that may be the case. We don't know exactly why it went up, but it did go up significantly for the second quarter. Unit labor costs restrained 1.6% after rising 6.9% in the first quarter. So overall, a fairly good news portrait of the economy this morning.
Michael McKee, thank you so much. Stay close. We will get back to you. Right now, seeing not a lot of movement in markets. On the margins, yields lower just by a couple basis points, particularly at the long end as people look to continuing claims. Just to give some size and scope, the continuing claims number came in at the highest level going back to November of 2021, a significant bump up with a question of this low churn dynamic. People low hiring, low firing, but if you find yourself out of work, it is taking a lot longer to get back into the workforce. Joining us now is Yelena Shulyatyeva of the Conference Board. Yelena, just on that point, how much is this indicating some sort of weakness, the idea that it is so difficult for people, or more difficult, I should say, for people out of the workforce to find their way back in?
Look, the data this morning actually shows the same kind of thing that it's been showing over the last several months. The insured unemployment rate remained at around 1.3%, and that's where it's been over the last several months. So we have seen a little bit of a pickup from the trough, but the idea is that there's not been that much upward movement in the unemployment rate, despite the fact that the pace of job creation has slowed. And that's the point that Chair Powell made.
Kay Moore was just talking about the fact that is the labor market frozen or actually deteriorating? What do you think?
I think it's frozen. So a couple of things to mention. So if you look at the data from the employment report last week, you'll see that the increase in the unemployment rate since its trough back in 2023 has mainly been driven by people's inability to find a job. So kind of long-term unemployment, and not by new layoffs. So that's point number one. Another thing is that this morning we saw a release of CEO confidence report for the third quarter of this year. That is in conjunction with the Business Council and the Conference Board. So, CEOs are feeling a little bit more optimistic. So confidence among C-suite, actually increased in the third quarter after collapsing in the second quarter. But CEOs are still citing difficulty finding qualified workers. What it means is that they will probably not be laying off people unless it's absolutely necessary. So that's what we hear from them. One thing is that, CEOs mentioned that they may be reducing the labor force, and that, share of those CEOs exceeded the share of CEOs that were expecting an increase in the labor force. But still, the majority of CEOs are expecting no change in the labor force. It's still fresh in their memory after the COVID recession that when they laid off a lot of workers, they had a huge difficulty hiring them back. And while the circumstances are different now, you still have a reduction in the overall availability of labor. among immigration slowdown. So that is creating, an issue for those CEOs.
Well, if CEOs are looking to lay off people when it comes to circumstances, is it because they're dealing with higher tariff rates and they need to make sure that they are basically hoarding some more cash? Or is it because what's going on in AI?
Well, at some point you have to cut costs, right? So labor is the most expensive thing, the highest cost for a company. So when your profit margins shrink and you just faced with the fact that you have to cut costs, that's where you go and look. But I don't think that is actually going to happen in the next few months or so. Look at unit labor costs, right? So they are decelerating. Growth in unit labor costs, another data released this morning. You see some deceleration in that metric, and that tells you that labor is getting, well, at least not more expensive in that sense.
Yelena, one thing that we kept hearing this week, including from Stephen Oth of Federated Hermes, was that a lot of the hard data is backward looking and that actually a lot of companies have more confidence now. They have more certainty. The uncertainty was paralyzing. Now that is lifted just a touch. And you can see a better path forward, that actually you are seeing confidence start to pick back up and that maybe things are turning in the other direction. Do you see any signs of that from where you sit, that that's actually what's going on?
Yes, we do talk to a lot of CEOs at the conference board. And again, the latest report on CEO confidence is actually telling you just that. So it collapsed. Confidence collapsed in the second quarter of the year, but it recovered substantially in Q3. And that report covers the period of the second half of July, essentially. So when we were getting a little bit more certain about the level and the ultimate size of tariffs. So now we will be pricing out some uncertainty, but also we need to price in the size of tariffs themselves and the impact of tariffs on the economy. We estimate the impact from tariffs on economic growth will be substantial, but at the same time, uncertainty impact was also very, very sizable, and that's not going to be in the cards anymore, at least not to the same extent. So I think there is a potential for some revival, even in the pace of payrolls going forward. So, maybe the latest data reflects some of this uncertainty that we had early in the year, and companies can kind of start planning ahead with a little bit more, precision.
And we certainly have seen that in the confidence data, just a touch higher as people take a look at what the landscape is right now. Yelena Shulyatyeva of the conference board, thank you so much for being with us. Michael McKee is back with us. Mike, you've been scouring through the data. What stands out?
Well, I think the markets are looking at kind of the same thing. I'm seeing the 10-year yield on the screen there absolutely diving. And it's basically that we are not seeing the economy collapse because companies aren't letting people go. But the real question is, now that they know what the tariffs are and the tariffs are in place and they start figuring out what it's going to mean to their bottom line, do we see that change? And that's the part where the Fed is watching very closely and kind of holding their breath. But on the other side, we do have these good productivity numbers. Manufacturing productivity was up by 2.1%. Durable goods manufacturing 3.3%. So some strength in manufacturing productivity, which is a good thing for overall growth, but it does maybe mean that companies don't need as many people. So we'll see how all of this plays out going forward.
Yeah, Mike McKee, thank you so much, as always, as people try to understand exactly where we are in the economic cycle. Joining us now, Seema Shah of Principal Asset Management. And Seema, thank you so much for being with us. You put this all together, and I guess, what do you get? I mean, now that we have tariffs, we have more certainty, we are seeing kind of a pivot point. At least that's what some people are saying in the labor market in the U.S. How much are you shifting your view heading into fall?
Hi, Lisa. I think there has to be some reappraisal after the payrolls report last week. I don't want to put too much emphasis on it at the same time. So clearly the payroll report was Very disappointing. Those downward revisions, very meaningful. But at the same time, we have been warning, and I think the rest of the market, that the break-even employment report was likely to fall, coming down to the kind of 70,000 level, which is kind of where we got to for last month's payroll. So we need to keep that in mind. At the same time as knowing that from a political side, I think it's going to be very, very difficult for the Fed to avoid cutting rates. And we've seen so many Fed speakers in the last few days falling onto that side with Waller. So we are expecting a cut in rate in September now. But I have to say, I don't think there's going to be much need for really aggressive rate cuts because we still have a constructive view of the economy. We still actually have some concerns about inflation. So I think from a market perspective, this is fairly constructive in a way that you're getting preemptive Fed cuts without a really, really concerning deterioration in the economy on the way. But of course, I think there's still a ton of uncertainty within the market to come.
Seema, is September for you a one and done, or is it sort of a cycle?
No, I don't think it's a one and done. I think I think we should see a couple of rate cuts. In terms of the timing, a lot of it is going to depend on how the CPI reports perform, as well, of course, the employment reports. But we are expecting 3 to 4 cuts. That is not that meaningful, but it's also very, very helpful for financial conditions in an environment where the economy is it's slowing, but it's still fairly robust. So I think for risk assets, for earnings growth, this is actually one of the reasons why you see the markets actually react pretty well this week to the news that we had on Friday last week.
You mentioned a number of Fed voices now coming up, lining up with the 2 dissents we saw in terms of talking about the cracks in the labor market. But what if we get hot CPI reports, especially since the tariffs, as of today, the higher rates actually take effect?
Right, and I think this is one of our points, is that from our perspective, should the Fed be cutting September? I would actually say that they should be holding off. But I think from a political aspect, having seen those kind of payroll reports, the pressure that is being put on them from the White House, it's going to be very difficult for them to avoid it. Now, in terms of how they proceed from there and how many rate cuts are going to be coming, that's where the CPI inflation reports can really have an impact. But I do think that the Fed is in a horrible position where they have to react to the employment reports knowing that there's some really conflicting signals from a labor supply perspective, labor demand, and then, of course, although tariff uncertainty has been somewhat cleared up, we can just see from the news flow overnight that nothing is really confirmed. So there's still so much news flow to come, which could have a really meaningful impact on the inflation agenda and, of course, on the economic growth backdrop.
Seema, is the economic resilience isolated to the United States, or is that a global story and really supports the sort of global investment picture that's had a lot of investors international over the past 6 months?
I think there is an element of economic resilience across a broad number of countries. I would say that the US is very well set up simply because of its strength in technology. So when you're looking at an earnings picture, the US does look pretty strong. But even if we're looking across to Europe, to the UK, we don't have really significant concerns about recession, but we can see that the tariffs are likely to put a more meaningful downward impact there. And so from a central bank perspective, maybe the agenda is a little bit clearer than what you're seeing from the Fed.
Seema Shah of Principal Asset Management, thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump is calling for major changes to the U.S. Census, posting it should exclude undocumented migrants. Trump instructed the Department of Commerce to begin work on it immediately. The U.S. Constitution mandates a census every 10 years to allocate federal funding and political representation. This comes amid a redistricting battle across the country that started in Texas. Meanwhile, President Trump will sign an executive order today to allow private equity, real estate, crypto, and other alternative assets in 401ks. The White House confirming the order will direct the Labor Department to reevaluate guidance around alternative asset investments and retirement plans. And Firefly Aerospace priced its shares at $45. That's above the marketed range. It marks the next evolution for a company that survived bankruptcy and turmoil to develop its own fleet of rockets and successfully land a private spacecraft on the move. Firefly will make its debut on the NASDAQ today under the ticker symbol FLY. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, setting you up for the day ahead. Plus, Tom Orlik of Bloomberg Economics on why getting lower rates may take more than appointing a new Fed chair.
if you're trying to come up with a view on the economy or a view on where things are going to go, you need a variety of data points that all kind of a mosaic, essentially, that gets you to a conclusion. And so, yeah, maybe in this environment, we need to look at a few more alternative data points to try to enforce what we're looking at. But I think also what we do need to be prepared for is more volatility in the data.
That black box is getting a little bit darker as we look forward into a very cloudy future. That was Kelsey Berro of JPMorgan Asset Management. A cloudy future looks bright if you're in the market. It's got futures higher on the day, going into the open up 0.6%, led by big tech, and we have seen that for the past week, as you do see some sort of reprieve, or at least perceived reprieve, when it comes to the potential semiconductor tariffs. We do see a little bit of dollar weakness, although today changing that a little bit on the margins. Euro dollar 116. Just basically flat. Yields just basically flat also after the jobless claims. Less than an hour away from the cash open. Here's your morning movers with Danny Berger. Danny.
Hey, Lisa, your future might not be so bright if you are some of the CEOs feeling the tension, but here is where the future does look bright is for Hertz Holding this morning. Shares are up 10.5%. Out with earnings moments ago, the loss was less than expected. This is a company that is really trying to engineer a turnaround in this moment. So a lower loss than expected is good. The CEO saying that they are cutting costs, have a smarter fleet. Bill Ackman probably happy about this. He took a 20% stake back in April. Now, a lot of various things when it comes to tech companies this morning. And if you're Apple and some of the chip suppliers to them, you are doing well. Apple announcing an $100 billion investment into the U.S. alongside President Trump. Anyone who invests in the U.S., Trump says, will get an exemption on the 100% chips tariff. Apple also trying to manufacture more of its parts in the U.S. So you're seeing Corning, for example, who makes the glass for iPhones, that rallying. Global Foundries, a U.S.-based chip business, that also rallying. Notably absent from the chip makers rallying this morning is Intel. It is hurting after Trump posting on Truth Social that its CEO should resign. Don't have shares of those at the moment, but I can promise you they're falling something like 5% this morning. Tom Cotton, the center over there, saying, writing to the board, saying that they should look into the CEO's ties, Lisa.
Thank you so much, Danny. Right now, counting you down to the opening bell. Here's a trading diary for the rest of the week and into next. 10 a.m. Eastern, Atlanta Fed President Raphael Bostic speaking. 1 p.m., the Treasury auctioning $25 billion in 30-year bonds. 4 p.m., we hear from President Trump delivering remarks. Next Tuesday, this is really going to be the big data point, CPI data. Thursday, PPI and another round of jobless claims. President Trump continuing his push for lower interest rates, blaming Fed Chair Jay Powell for getting in the way. But a new book raises questions about how easy it'll be to get lower long-term borrowing costs, regardless of who's at the Fed. Tom Orlik of Bloomberg Economics, one of the authors of The Price of Money, joins us now. Tom, thank you so much for being with us. Why is it that you think there is a new structural regime for benchmark rates that's going to make it a lot more difficult to get them lower over the next 10, 20 years?
So it's a great question, Lisa. So let's cast our minds back briefly to the early 2000s, to Ben Bernanke, and to the famous savings glut hypothesis. So back then, the Fed was hiking, but long-term Treasury rates weren't going up. And Bernanke said, it's because there's a glut of global saving, all of this money coming from China and Saudi into the US Treasury market. And that means even as the Fed hikes, long-term rates are staying low. So the big thesis, which Bloomberg Economics, my co-authors, Jamie Rush, Stephanie Flanders, and me set out in this new book, The Price of Money, is that situation has reversed. And we're no longer in a world with a savings glut. We're in a world with a savings shortage. And that means it doesn't matter who President Trump appoints as the next Fed chair. He can appoint Kevin Hassett. He can appoint Kevin Warsh. He can train an AI model to make the same decisions as Arthur Burns, the notorious Fed chair who cut rates for Nixon back in the 1970s. And he can get a short-term policy rate, but that savings shortage is going to mean that long-term rates, the 10-year Treasury yield, stays high. We think 4.5% for the 10-year Treasury is the new normal.
Yeah, something also the administration would not welcome, because also I see you say it might actually trend above that figure. What does this look like in terms of a transition for 4.5% a 10-year yield being the new normal?
So it's a great question, Annmarie. So this book's about the natural rate of interest. It's a bit of a wonky concept. It fires the imagination of PhDs and the folks in the Fed, can leave others cold, but it's actually pretty important, right? If you're the US Treasury, well, 10 years ago, you were borrowing at the 10-year horizon with a 2.5% rate. That was very sustainable. Now you're borrowing at a 4.5% rate. Well, that puts us into a world where the US is going to be spending more on interest than it does on defense. If you're in the equity market or the real estate market, if you put money to work in stocks and real estate in the US, pretty much any time over the last 4 decades, you've made a lot of money, and an important reason for that has been that interest rates have been low. Well, if we're right, we're now moving into a world where interest rates are going to be structurally higher, and that means the pressure on stocks, the pressure on property isn't going to be for prices to rise, it's going to be for prices to plateau or maybe even fall.
Tom Orlick of Bloomberg Economics, thank you so much, and looking forward to reading your book, The Price of Money, which does come out today. Honestly, this is going to be the theme going forward, and frankly, a big discussion in Jackson Hole. Are we looking at a new, much higher neutral rate that really does challenge some of the pricing that we experience on assets?
Well, according to Tom and the team, we are, and that's the new normal for a very long time. What's interesting is he says it doesn't matter who the Fed chair is, even if it's someone so overtly political or someone who on the surface doesn't look political, but behind the scenes, like Nixon and Burns, actually is very political. It doesn't matter, because this is the trajectory we were going into.
Yeah, or potentially it could exacerbate it, like we saw during the Arthur Burns Federal Reserve. Coming up tomorrow, I will not be here. We've got Annmarie holding down the fort, Lori Calvasina of RBC joining, Neil Dutta of Renmax, Savita Subramanian of Bank of America, and Colin Martin of Charles Schwab, as we look forward to CPI next week. A real question about whether you're going to see that ongoing grind of maybe slightly weaker growth, slightly higher inflation, and how much that does dovetail into Fed policy. Right now, still a real positive tone across the board in markets as people look forward to earnings that have been better than good, as well as the expected Fed rate cut that people are pricing in for September. Right now, we are seeing just a touch of a sell-off in the bond space, but in the long end, 30-year yields, just a touch lower ahead of that auction later today. Good morning.